standard deviation of P, okay, square the weight of project P times the standard deviation of project P. Then we add the square of the standard, the square of project, we square the weight of project R, then we square the, we multiply, we are going to multiply the standard deviation, the square, this is just the variance, the variance of project R, all right, R, all right. Then candidates, we add 2 times weight of project P times weight of project R, then we multiply by the covariance. This is the covariance of PR, covariance of PR. So candidates, square the weight of P, square the weight of P, 0.6 squared times the square of the standard deviation of P, standard deviation P from the question, standard deviation 2.5 square plus 0.4 square times standard deviation R 2.3 square plus 2 times 0.4 times covariance of PR, covariance PR from the question, covariance PR 1.3. The rest is the work of the machine. We multiply 0.6 square times 2.5 square plus 0.4 square times 2.3 square plus 2 times 0.6 times 0.4 times 1.3. This is equal to, then I need to, before I need to get the square root 1.93. 1.93 is the standard deviation of the portfolio PR. We will do the same for combination QR. We will first calculate expected return, the expected return for combination QR. We'll have QR, this is the projects. Let me have columns, projects. Then we have initial investment. Then we have the weights. Then we have the expected return. Then we multiply the weight expected return. So project Q required initial investment of 7 million. Project R require initial investment of 6 million, total 13 million. So the weight will be, the weight is going to be 7 divided by 13 7 divide 13, 0.5. Then 6 divide 13, 0.464. Expected return. The expected return from the question we have project Q, 21%, project R, 16%. Therefore, the expected return for this portfolio is going to be 0.54 times 21 plus 0.46 times 16%. 0.54 times 21, 11.34, 0.46 times 16, 7.36. We add 11.34 goes to 18.7%. This is the expected return of the portfolio QR. Then the next requirement is the correlation coefficient. Correlation coefficient QR. Correlation coefficient QR is equal to the covariance of QR over the standard deviation of Q times standard deviation of R. Okay? Covariance of QR provided in the question is 1.5. Standard deviation of Q 1.8 times standard deviation R 2.3. It's that simple. 1.5 divide 1.8 times 2.3 is equal to 0.36. Then lastly, we are going to compute the standard deviation of the portfolio QR, standard deviation of the portfolio QR, which will be determined by getting the square root of the weight, square the weight of Q times standard deviation of Q plus weight of R times standard deviation square over R. Then we are going to add 2 times the weight of Q times the weight of R. This is times the covariance QR. Covariance QR. This will be equal to the square root of 0.54 squared. Square the standard deviation 1.8 square plus 0.46 square times standard deviation of 2.3 squared plus 2 times 0.54 times 0.46 times the covariance of QR. The covariance of QR 1.5. That will be this is 0.54 times 0.54 squared, 4 squared times 1.8 square plus 0.46 square times 2.3 square plus 2 times 0.54 times 0.46 times 1.5. Then we get a square root. This is equal to 1.68. 1.68 is the standard deviation. We do the same for portfolio QS candidates. We will begin with the expected return for portfolio QS. I need space. Let me use this space. Expected return portfolio QS. For portfolio QS, we begin with the project Q, project S. Project Q requires initial investment of 7 million. S required initial outlay of 8 million. 8 million. Total 15 million. The weights will be 7 divided by 15. 7 divide 15, 0.4. 8 divide 15, 0. This is 5.3. This is 0.47. Those are the weights. Then we'll calculate we have the expected return given in the question for project Q. Expected return, project Q, 21%. Project S, expected return, 14%. So the expected return for the portfolio, QS will be 0.47 times 21 plus 0.53 times 14%. Okay, the expected return for the portfolio QS will be 0.47 times 21% plus 0.53 times 14%. 14%. Therefore, 0.47 times 21% is 9.87%. 0.53 times 14 is equal to 7.42% plus 9.87%, 17.29% is the expected return for the portfolio QS. Then we compute correlation coefficient for the same correlation coefficient for the portfolio QS. We know this is equal to the covariance of QS divided by the standard deviation of Q times standard deviation of S. Covariance of QS is provided, candidates, where it is written that the covariances between the various project combinations are as shown. Covariance for project QS, the second last, 1.7 divide standard deviation also given in the question for Q, 1.8 times the standard deviation is 1.6. Therefore, the correlation coefficient portfolio QS will be 1.7 divide 1.8 times 1.6. This is equal to 0.5. 0.59 is the correlation coefficient for the portfolio QS. The next requirement is the standard deviation of this combination or portfolio. The standard deviation of portfolio QS will be equal to the square root of the square of weight of Q times the square or the variance of Q plus the weight of the square of the weight of S times the standard deviation squared of this is S. Then we are going to add 2 times weight of Q times weight of S times the covariance of QS. Covariance of QS. So this is equal to, this will be equal to the weight, we have it 0.47 squared. Standard deviation, we have it 1.8 squared plus weight 0.53 squared times standard deviation 1.6 squared plus 2 times 0.47 times 0.53 times covariance of QS, the covariance of QS 1.7. This will be 0.47 square times 1.8 square plus 0.53 square times 1.6 square plus 2 this is times 2 times 0.53 times 0.47 times 1.7. Then we get the square root. The answer here is 1.51. 1.51 is the standard deviation of portfolio QS. A portfolio is an investment or is a combination of investments, a set of investment, a group of investment. This company had an option of investing in project Q and S combination. This is combination QS. So the standard deviation of this portfolio is 1.51. Then we will again compute the expected return for combination RS, project RS, combination RS. Okay, so I'm going to have here the expected return for RS. So we'll begin with the project R and project S. Project R required the initial outlay of 6 million. Project S required initial outlay of 8 million. So we do the weights. This is 14 million. Therefore, the weight will be 6 divide 14 to get 0.42. Then we have 8 divide 14 to get 0.57. When we round off here, we have 3. Then there is the expected return for individual projects given in the question for project R is 16%, 16%, project S 14%, 14%. Therefore, candidates, the expected return for the portfolio RS will be equal to 0.43 times 16% plus 0.57 times 14%. So 0.43 times 16%, 0.43 times 16% is equal to 6.88%. Then 0.57%, 5.7 weight times 14% is 7.98%. The total is 6.88 plus 7.98, total 14.86%. That is the expected return for the portfolio RS. Portfolio RS. Now, candidates, I'm going to rub here so that I can compute the correlation coefficient for the portfolio RS. Then I also compute the standard deviation for RS. But before I rub, candidates, I will need to have this somewhere. This is the expected return of the first combination. This one here, 13.6. 13.6. I'll need this 13.6% in the second requirement, Roman 2, where we are told to advise the shareholders of Mali investment on the optimal project paired on the mean variance. To calculate the mean variance, candidates will divide standard deviation by the mean. In this case, the mean is the expected return of the portfolio. So I will rub here. Rub that. So candidate 13.6% is the combination PR. First combination was PR. PR expected return, first combination PR. This is equal to 13.6%. I'll need that when computing the coefficient of variation, or the mean variance, Let's continue. We've done the expected return for portfolio RS. We are now going to compute the correlation coefficient RS, project RS. That will be equal to the covariance of RS divide the standard deviation of R times standard deviation of S. Covariance of project RS, portfolio RS, covariance RS 2.7 divide the standard deviation of R 2.3 times 1.6 times 1.6. So candidates, that will be the correlation coefficient, which is equal to 2.7 divide 2.3 times 1.6. This is equal to 0.73. Then lastly, standard deviation of the portfolio RS is equal to the square root of W squared R standard deviation squared r plus w squared s times standard deviation squared s plus 2 into w r r times w s, okay, times covariance r s. Covariance r s, this is equal to the weight, we have it 0.43 squared. The standard deviation, we have it 2.3 squared plus weight 0.57 squared. Standard deviation 1.6 squared plus 2 weight 0.43 times weight 0.57 times covariance, we have it 2.7. The rest is the work of the machine, the calculator. 0.43 square times 2.3 square plus 0.57 square times 1.6 square plus 2 times 0.43 times 0.57 times 2.7. Then we get the square root. The answer is 1.77. That's the standard deviation. Candidates, we've answered Roman 1, which read, for each possible project pair combination, calculate the expected return, number 1. Number 2, correlation coefficient. Number 3, standard deviation. That's what we've been doing for each project combination. For example, the project combination for QS, we've done the correlation coefficient. We've done the expected, firstly the expected return. We did the expected return, then we've done the correlation coefficient, we've calculated the standard deviation for the portfolio, we've QS, that is QS, candidates, that is QS. For each project we have done the expected return, correlation coefficient, and standard deviation. For project RS, we've calculated the expected return, we've calculated the correlation coefficient, we've calculated the standard deviation. We did the same for project PR, we did the same for project QR. So we are going to move to answer the second part of this question. Advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance. The mean variance is also known as the coefficient of variation. So I'm going to rub this bit, but maintain, I'm going to maintain, this is QR. This one here is the expected return QR. We want to calculate the coefficient of variation or the mean variance. How to calculate the mean variance? Mean variance, candidates, mean variance is equal to the standard deviation over mean. So mean variance is equal to standard deviation divided by the mean. In our case, the mean is the expected return. The expected return is the mean. We have done the standard deviation for each portfolio. All right, for each combination of projects, we've calculated the expected return for each portfolio. So we want to determine the mean variance for each portfolio. And this one here, candidates, 18.7% is the expected return for QR 18.7%. I'm writing it down there because I want to use this space. I want to use this space. So I have combinations. Then I'll have the first combination is PR. We are going to calculate the mean variance for PR, and I've said is equal to mean divided by, the standard deviation divided by the mean. The standard deviation for PR, we calculated it 1.93. We divide the expected return for combination PR. Expected return here is 13.6. The next combination is combination QR. The standard deviation QR is 1. We calculated it 1.68 divided by the expected return QR 18.7. Then the next combination is combination QS. Combination QS. The standard deviation combination QS is 1.51. QS 1.51 divided by the expected return QS. QS is QS we calculated it. QS expected return QS here is 17.29. Then lastly, combination RS. The standard deviation combination RS, we have it here, 1.77 divide the expected return RS, 14.86. These are the possible combinations and the mean variances. So begin with the PR 1.93 divide 13.6 is equal to 0.14. When converted into percentage, this is 14%. Next is 0.08. Next, 1.51 divided by 17.29. 1.51 divide 17.29. 0.087. Then lastly, RS 1.77 divide 14.86. 0.119. Now, when converted into percentages, this is 8.9%, is equal to 8.7%, is equal to 11.9%. So those are the mean variances. These are the mean variances. Then based on these mean variances, we are to advise this company. The question reads, advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion. Now, the most ideal combination or optimal project pair, advise the most ideal project pair, as you can see, candidates is QS, and why? Because it has the least mean variance or coefficient of variation of 8.7%. That means the project the risk is lower risk. It has a lower risk. Okay, 8.7%. So we've answered that question, candidates, and I hope you take time to go through it. I hope you've also seen that the question is simple to the extent that candidates required to just have the formula. If you have the formula for these requirements, like the correlation of coefficient, then you put down the formula, then check from the question if the inputs are provided in the question. Like candidates, you see correlation of coefficient is equal to the covariance of RS. The covariance of RS is given in the question. The standard deviation is also given in the question. That would earn you marks. All right. And before calculation of the relation of coefficient, it was important in this question for the candidate to first of all identify the possible project combination. Because we read in the question that this company had a limit of 15 million shillings to invest in various projects that we were provided the initial capital outlay. So it needed simple mathematics, like in project P. Project P required 9 million, project Q required 7 million. So combination of P and Q was not possible because 7 million plus 7 million, 9 million plus 7 million exceeds the limit of 15 million. That's why we didn't have that combination in our working. So you see, that was the initial starting point. First of all, identify the possible projects combination. And this is what now guided the student on how to calculate these other aspects, the correlation coefficient, the expected return, the standard deviation. So it's important, candidates, you practice. Look at these questions are just the same, but they are varied slightly. So if you get the concept, then it becomes easier for you to answer any question that may be tested in the exams. Thank you for attending today's revision session. In our next session, we have number 4 that was tested in November 2020. Then we'll again answer question 5. We are dedicated to providing all solutions for the CPA students appearing in the Advanced Financial Management paper. Thank you. God bless you. Bye-bye.
Welcome to manifested publishers are Mr. Bernard Mariga. We can start with a question in August of 2022. Let's start with a question in August 2022. 2022, question 3B. August 2022, question 3B is a question I want us to deal with. Question 3B of August 2022. And this question states, a hotel with 50 single rooms is recording 80% occupancy in a normal season of 8 months and 50% occupancy in off-season of 4 months in a year. The following information is provided. You have annual fixed expenses, staff salaries excluding room attendants of 7.5, repairs and maintenance of 2.6 million, depreciation on buildings and furniture of 2.4 million, other fixed expenses like dusting and sweeping is 3.25 million. So that your total fixed cost is 15,750. Variable expenses per guest per day. Linen and laundry is 300. Electricity and other facilities 200. Miscellaneous expenses 250. Then the management wishes to realize a profit of 25% on total cost. 25% on total cost. Required. Number 1, the required tariff rate per room. Number 2, the break-even occupancy in normal season, assuming 50% occupancy in off-season. Number 3, the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season, respectively. Advice on the appropriateness or otherwise of the above proposal. So let's analyze what we have been given in this question. One of the items you have been given is the fixed costs. And your fixed cost in total is how much? 15,750,000. 15,750,000. Then you also have another cost that is known as a variable cost. And the variable cost, remember, is a cost that increases with output. It also decreases with output. A good example of a variable cost is direct material, direct labor, direct expenses. Variable overheads should also be added to those costs I have mentioned above to determine your variable costs. So your variable cost here, they have said there is a linen and laundry of 300 plus electricity and other facilities of 200 plus miscellaneous expenses of 200 and what? 50. Of 250. So that 300 plus 200 plus 250, 300 plus 200 plus 250 should be 700 and what? 50. 750. Then we can then answer, go back to what we require, what the question is asking. They want the required tariff rate per who? Per room. The required tariff rate per who? Per room. So the required tariff rate per room. So in this question, what they are simply asking you to do is to determine your selling price P. That is what they want you to determine. That is what they want you to determine, okay? Or your revenues, So we are going to take our annual fixed costs. We are going to take our revenues as your fixed costs plus your variable costs, let me say fixed costs, let me just write it in full, fixed costs plus variable costs plus your profit. So your sales revenue is simply the cost. Remember, these are the costs, total costs, plus your profit, okay? We already have the fixed costs, which we have seen as 15,750. The variable cost here is 750, but it is per who? Per guest per day. So we need to determine our total variable costs. Our total variable costs. How do you do that? You determine your total variable cost by taking the variable cost per unit, you multiply that by your units. And in this case, you want to multiply that by the number of guests you have in an organization. In this organization. So let's determine the number of guests you have, where Q, in this case, is your number of who? Guests. Q is your number of who? Guests. Let's determine the number of guests. The first paragraph on us, they're saying a hotel with 50 single rooms is recording 80% occupancy in normal season of 8 months and 50% occupancy in off season of how many months? 4 months in a year. Then assume a 30-day month in all cases. So let's determine, we write there, determination of the number of guests. Or the occupancy. We are going to take that by taking during peak season. You had 80% occupancy. You multiply that by the 50 rooms that organization has. They are occupied for how many months? 8 months. 8 months. Then you multiply by the number of days. Number of days, that is during peak season. Plus, you also do the same for what? Off peak season. And how will you do that? You're going to take 50% occupancy. The rooms that are being occupied are 50 rooms. The off-peak season lasts for 4 months. But each month has how many days? 30 days. 30 days. So let's identify the occupancy level. Let's identify the occupancy level. During peak season, you expect 9,600 as the number of what? Guests that will occupy that. Then during off-peak, you expect 3,000 guests. So that in total, you're going to have how many guests? 12,600 guests. You're going to have 12,600 what? Guests. The reason we are determining the number of guests, remember, is so that we can be able to determine our total variable costs, which will be the product of a variable cost per unit that already we have of 750. Then by the number of units, which are your guests, which are how much? 12,600. So therefore, your total variable costs will be your variable cost per unit of 750. You multiply by 12,600. 750 times 12,600. So therefore, your total variable cost is 9.4 million. 9.45 million. Once we have determined our variable cost, we then will add our fixed cost to determine our total costs. Then our what? Profit. So let's come here and say that your total fixed costs. Your total fixed cost is how much? 15,750,000 plus your variable cost will give you your total costs. And how much is your total cost in this case, class? $25,200,000. That is your total what? Costs. But remember, to get our revenue, we simply take our total cost plus our what? Profit. So then we need to add our profit. We need to add our profit. And they were saying that profit is 25% on what? Cost. So this is known as profit markup. So you're going to say 25% of 25, 200 what? 1,000. That will give you 6.3 million. 6.3 million. So to get our revenue, you then add, which is 31,500 what? 1,000. 31,500,000. You refer to that as your total revenue. As your total revenue. When we have our total revenue, we can now determine our what? Selling price per unit. We can determine our selling price per who? Per unit. So let me do away with this. You know that to get your revenue, you simply take your selling price per unit, you multiply by your units. Therefore, our revenue can be used to determine your what? Selling price per unit by simply taking your total revenue, you divide by what? Your units. Your total revenue is how much? 31,500,000 divide by 31,500,000 divide by your total number of what? Guests. In this case, we are dealing with a hotel, so we normally have got what? Guests. So therefore, divide by the total number of guests, which are 12,600. So please confirm that that is 2,500 per who? Per guests. 2,500 per who? Per guests. So each guest will be charged how much? 2,500. So that's the first part of that question. The required tariff rate per who? Per room, eh? All right. Then note number 2. Note, and that should be per room. Note number 2. The break, or rather, required note 2. The break-even occupancy in normal sales, assuming occupancy is 50% of season. Eh? So the break-even point. Break-even point. All right. So we can have this in what? In units, which in this case is in your what? Guests. Your guests are the measure of what the company is producing. Eh? To determine your break-even point in units, you simply take your fixed costs, divide by your contribution margin. Divide by your contribution margin. Your contribution margin, we've said, is the difference between your selling price and your variable cost per unit. Your selling price, we've just determined it as 2,500. Your variable cost per unit was 750. So therefore, to determine the contribution margin from the above, you will take 2500 divided by minus 750 to get a contribution margin of 1750. So your break-even point in units will be a fixed cost. Your fixed cost was 750,000 divide by 1750. Divide by 1750. So for that organization to be able to cover its cost, they need to have to occupy 99 rooms or what? Guests. Right. In shillings, what sometimes they refer to as break-even point revenue. Revenue, shillings, or sales. If you see break-even point revenue or sales, it basically means break-even point in what? Shillings. It is determined by taking your fixed cost, divide by contribution margin sales ratio. Divide by contribution margin sales ratio. Your contribution margin sales ratio is given by contribution margin divided by selling price. Contribution margin divided by selling price. Your contribution margin is 1750 with a selling price of 2500. With a selling price of 2500. So your contribution margin sales ratio is 0.7. So therefore, your break-even point will be 750,000 divided by 0.7. Divide by 0.7. So for that company to be able to break even, they need to sell 22,500,000. They need to sell 22,500,000, which could also be obtained by taking your break-even points in units, you multiply by your selling price. You multiply by your selling price. So these two answers should be the same. Those two answers, indeed, they are the same. So those two answers, indeed, they are what? The same. All right. Part 3 of that question. They are saying the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season respectively. Advice on the proposal above. So part 3. Decrease selling price by what? By 20%. Decrease the selling price by 20%. Now, to analyze this question, this particular question, there are two ways we can do that. Number one, we can determine the profit of that company after they have dropped the selling price by 20%. Number two, we can determine the contribution as a result of dropping the what? The selling price by 20%. Once we have done that, we then compare with our current what? Selling price. So when you're making decisions here, you normally make decisions considering by taking the contribution or the profit. The contribution or the what? Profit. So let me see. Let us do this together. Let's do this together. Your new selling price P. The decrease by 20%, it means your new selling price will be 80% of the current selling price, and the current selling price is what? 2,500. So that's your new selling price. The variable cost is not changing. It is still going to be 750, which is 300 plus who? 200 plus 250 to give you how much? 750. So that now your contribution margin will be 2,000 minus what? 750. It will be 1250. 1250. Your contribution margin sales ratio, is your contribution margin divided by what? Divide by P. 1250 divided by 0.625. That is your new what? Contribution margin sales ratio. To determine your profit, you know, you simply take your contribution margin, you multiply by your units minus your fixed costs. Alternatively, you can take your contribution margin sales ratio, you multiply by your revenue in shillings minus your who? Fixed cost, minus your revenue times your revenue minus your fixed cost. Let's determine the units as a result of what? The drop in what? Selling price. They're saying that if you decrease the selling price by 20%, you're going to improve occupancy at 100% and 70% in the normal what? Season. So we need to get our new the number of guests that are going to occupy that. So you're going to say it is 50 what? Rooms that are being occupied what percent? 100%. They are being occupied for how many months? 8 months during peak season. And you know each month is having how many days? 30 days plus there are 50 rooms that will be occupied 70% of the time. The occupancy during off-peak is how many months? 4 months. Then per day is how much? 30 days. 30 days. So this means that is 1,200 guests. That is 4,200 guests. Right, so that the total here will be 16,200 who? Guests. So when the company reduces the selling price by what? By 20%, your occupancy will increase or will come to what? 16,200. Let's get now the profit. Let's get the profit. You're going to say your profit here is your contribution margin. Your contribution margin was 1,250. You multiply by how many guests? 16,200 minus a fixed cost of 15,750,000 or 15,750. So therefore, your profit should be 4,500,000. Now, then let's advise them. Remember, they are saying we advise them. We want to advise them on whether they should drop the selling price by 20% or they should continue selling and continue with the selling price of how much? 2,500. Now, when your selling price is how much? 2,500. Your profit is how much? Your profit in shillings and your selling price is 2,500. Your profit is 6,300. 6.3 million. When you drop your selling price by 20%, to how much? To 2,000. Your profit is how much? 4,500,000. 4.5 million. So there is a decline in profit by what? By 1,800 or 1.8 million. So therefore, what will you advise them? You're going to tell them to continue with selling price of how much? Of 2,500. Why is that so? Because the profits have dropped to 4,500 when you have done what? When you have dropped your selling price with an intention of increasing your occupancy. So kindly tell that organization not to drop its what? Selling price, not to drop its selling price. All right. Now that we have understood a single product, CVP, in your own free time, you can look at April 2023, question 4C.
Hello learners, welcome to Manifested Publishers e-learning portal. My name is Celestine Wandabusi. In our today's session, we are looking at a revision of Management Accounting April 2022. I just urge you to follow closely. Make sure you have your calculator with you so that we move together. Welcome. So I'm beginning with question number 1, part A. The question reads, cost accounting uses information provided by financial accounting together with other details of internal operations of an organization. With the reference to the above statement, describe 3 similarities between cost accounting and financial accounting. So we want to look at what are the similarities between cost accounting and management accounting. Number 1, we have periodicity of reporting. 2, accuracy is maintained in both systems. 3, the results of the business is revealed in both systems. 4, vouchers and we have vouchers and invoices forms the basis for recording of transactions, for recording business transactions. Number 5, we have fundamental principles of double entry is maintained in both systems. So these are some of the similarities between cost accounting and financial accounting. We have periodicity of reporting. In cost accounting, periodicity is more frequent than in financial accounting, where in financial accounting we have reporting done either semi-annually or yearly. But in cost accounting, it may be done weekly, monthly, or on yearly basis. But in both systems, we have that periodicity of reporting. Then we have accuracy of accounts being maintained. In both systems, we ensure that there is no biasness, there are no mistakes, errors, or omissions. So accuracy is maintained in both systems. Then number 3, we have results of the business revealed. The intention is simply to know whether there is any profit or loss being made, or to know the financial position of the business. And therefore, in both systems, we have results of the business being revealed. Note number 4, vouchers and invoices form the basis for recording of business transactions. They form as part of the books of books of subsidiary entries, which help in like creation of any other account. So we apply that in both systems. Number 5, we have fundamental principles of double entry. Whenever we are passing entries in both systems, double entry principle must be applied. So those are the similarities in the two systems. We move on to part B of the question. We are told that Rengo Limited has provided the following data for the financial year 2022. Number 1, we have budgeted output for the year, which was 9,800 units. Note 2, we have standard details for 1 unit. Under that, we have direct materials, we have direct labor costs. We've been given variable overheads and fixed overheads. So required, prepare a standard cost statement of unit cost showing prime cost, Roman 2, variable production cost, Roman number 3, total cost, and Roman number 4, selling price per unit at a notion profit of 15% on cost. For you to be able to answer this question, you need to understand what you need to consider, especially pertaining the data that you've been provided with. The question requires you to compute the total cost, but in that total cost, you need to show the subtitles. Prime cost, show the variable production cost, the total cost, and the latter show the selling price. So the best way of answering this question is simply preparing what we refer to as the cost sheet, which will enable you to show all the costs incurred, get the total cost, and then show the selling price. So this will be computed as follows. This is Rengo Limited. Note number 2, we are told that standard details for 1 unit, direct materials is 4 square meters at 530. So to know the amount for that particular, for the raw materials, we are simply taking that quantity and then you multiply by the price. So we'll have 40 meters times the price, which is 250, which gives us 10,000. Then we have direct labor. We are told this was incurred in 2 departments, so we have bonding cost center. The quantity is 48 hours. You multiply by the price per hour, which is 250. So this should be 530, not 250, 530. So we calculate this. This should be 21,200. This is 12,000. Still under direct labor, we also had another department which is finishing cost center. The hours used were 30 hours and the price per hour is 190. So you simply multiply 30 hours times 190. Which will give us 5,700. So add this. This is 17,700. In our part 1, we were required to show the prime cost. You now show the prime cost. Prime cost is simply the total of direct materials, direct labor, and direct expenses. So since we do not have direct expenses, the total prime cost will simply be direct materials plus direct labor. So this will amount to 38,900. So you've already answered part 1. In Roman number 2, you are told to calculate the variable production cost. So we now calculate variable production cost. When you look at note number 3, we are told that budgeted costs and hours per annum. Variable overhead, you've been given hours, and then we have shillings. So we have bonding cost center. Hours were 500,000 and the amount is 3,750,000. So we have not been given the cost per unit. For you to calculate the cost per unit, we do what we refer to as calculation of an absorption rate, which is simply based on the cost that is given divided by the number of hours that have been given, and that will give you the cost per unit. And therefore, in the bonding cost center, to calculate the cost per unit, you are simply taking 3,750,000. Then you divide that by 500 hours. You divide that by 500,000 hours. And then we were told that it is related to direct labor. So the direct labor hours that were incurred in the bonding cost center were 48 hours. So once you get the cost per unit, you now multiply by the number of hours that were incurred in that particular department. And this will give us the cost per unit for that center. So when you calculate you'll get 360. You do the same for finishing cost center. For cost finishing, we have 1,500,000 shillings. We are dividing by 300 hours to get the cost per unit. Then you multiply by the number of hours that were incurred in the finishing department, which was 30 hours. This will give us 150. Then you get the total. And this is 510. And that's part 2 or Roman 2 of that question, variable production cost. Then we move on to Roman 3. We are to compute the total cost. Still on that note number 3, we were given fixed overheads. So we are to calculate the fixed overheads. And under the fixed overheads, we've been given the amount for production. And remember, in note number 1, we were told that budgeted output for the year was 9,800 units. So to get the cost per unit, you are to take the production amount of 39,200,000. Divide this by the number of units that were produced, which is 9,800 units. Then multiply that. Sorry, we don't need to multiply, and get the cost per unit. So calculate that. This will give us 4,000 shillings. We also have selling and distribution, fixed overheads, and the amount is 19,600,000. Divide this by the number of units that were produced, which is 9,800 units. Then divide that. So this will give us 2,000. And then lastly, we have administration. Administration overheads, the amount is 9,800,000 divided by the units of output to get the cost per unit. And this will give us 1,000. Then get the total, which will give us the total cost. So we are adding from 38,900 plus 510 plus 4 plus 5,000 plus 5,000, which will give us 44,410. So that is the total cost. In Roman number 4, the question requires us to calculate the selling price per unit at a notional profit of 15% of cost. 15% of cost. So we already have the total cost of 44,410. We need to calculate profit, which we are told it is 15% of the cost. So calculate 15% of 44,410, which will give you 6,662. And then from there we now get the selling price, which is now the total of the cost plus the profit. And this will give us 51,071.5. This will be the selling price. So that's how you are to answer part B of question number 1. We proceed on to Roman number, to part C of the same question. We are told that Jumbo Limited manufactures bracelets for export trade. The sales revenue is dependent on level of advertising expenditure per month. The company has recorded the following sales information for the past 6 months. So we've been given the information about advertising expenditure and sales revenue. And then we are told that the following has been calculated. So you don't need to calculate, the figures have already been given. Then required, estimate fixed and variable elements of the sales revenue using the least square regression analysis. To use least square regression analysis, you need to know how to determine the values of A and B. And therefore we have a formula which we use to calculate the values of A and B. So the regression formula is as follows. Sum of y equals NA plus B sum of x, and sum of xy equals A sum of x plus B sum of x squared. So these are simultaneous equations which must be solved together, and the intention is simply to find the values of A and B. So we have already been given information. We are told in that question that sales revenue is dependent on the level of advertising. Whenever you are answering this question, always be able to identify the independent and dependent variable. So the question has already interpreted for you what is the dependent variable and what is the independent variable. We have advertising expenditure and sales revenue. you've been told that sales revenue is dependent, meaning the sales revenue is our Y variable, which is the dependent variable, and advertisement is the X variable, which is the independent variable. Under that table, you've been given the values. So what we need is sum of Y. Remember, we are saying that sales revenue is the dependent variable, and dependent variable is abbreviated by Y. So sum of sales revenue is given as 192,000. So just reduce the zeros based on the table that we've been given above. So we'll have 192 shillings equal to, N is referring to the number of observations or items that we have, which are already listed, and there are 6. So we have 6A plus sum of X. What is the sum of X? X is referring to independent variable, which is advertisement. You are given sum of advertising expenditure, which is 13.5. 13.5B. So this will become our first equation. Then we move on to equation number 2. We have XY, which is referring to advertising expenditure times the sales revenue, which again we've already been given. So this is 147,000.25 equals sum of X, that is sum of advertisement, is 13.5A plus sum of X squared, that is advertisement expenditure squared, which is 32.125B, and this will become our second equation. So from there we solve the equation simultaneously. We want to eliminate A. So to eliminate A, we must make values at A equal. To make equal, simply cross multiply. We have line 1 being multiplied by 13.5, multiply line 2 by 6. And remember that 6 and 13.5 is affecting all other values. So you multiply 192 times 13.5, which will give us 2,592. These are shillings, equals 6 multiplied by 13.5. This is 81A plus 13.5 squared. This is 182.25B. Do the same for the second line. We are multiplying all the figures by 6. So 147.25 times 6. This is 883.5, which will equal to 13.5 times 6 will give us 81A plus times 6. So this times this will give us 192.75B. Then you subtract. We are using elimination method. Subtract the values. So we are using elimination method. This should be 447, not 147. So 447.25 multiplied by 6 gives us 2,684. So we then subtract the figures. 2592 minus 2684. This will give us negative 92, which will be equal to, this is a 0. Then 182.25 minus 192.75. will give us negative 10.5b. From there, our intention is to find the value of b, so we divide both sides by negative 10.5, divide both sides by negative 10.5. So b will be equal to it will be equal to 8.76. 8.76. So once we find the value of b, we now use that to calculate the value of a. So regression analysis equation is in the form of y equals a plus bx. And so for us to find this a, we are to use the first equation because it has smaller figures. So we'll have 192 equals 6a plus 13.5. We already have the value of b, replace that with 8.76. Then you solve it. So we have 192 minus 118.25 equals 6a. So 73.74 equals 6a. Then we divide both sides by 6. Therefore, a will be equal to 12.29. And that is the value of a. So the question simply required us to find the value of fixed and variable elements of the sales revenue. So what are the fixed? In this equation, y equals a plus bx. A is referring to the constant, which is the fixed cost, and b is the variable cost. So we've already calculated the value of a and the value of b. So b is the variable cost and a is the b is the variable cost per unit and a is the fixed cost. And that is what was required in that question. Thank you and bye-bye.
Welcome to Manifested Publishers. We proceed on economics paper. That is April 2024. The last question, question 1. Explain the term producer equilibrium as used in economics. Explain the term. That is 7 Roman A Roman 1. Explain the term producer equilibrium as used in economics. I just want to draw a diagram before I explain that, basically explain that producer equilibrium. We can have this. This is an isocost. That is basically an isocost. So we have capital, and we have labor, and we have labor. This is an isocost. So AB is an isocost line. Then we draw an isoquant, not in difference curve, but isoquant. And then we have Q. We can say Q is 3. So the point that isoquant line forms a tangent with an isoquant, that is where we get the producer equilibrium. So we have equilibrium quantity of capital, that is KE, and equilibrium quantity of labor, that is LE. So we can say that this is 3,000. So we basically need to understand that 3,000 in this particular 3,000 units is the level of output, is the level of output, is basically the level of output, is the level of output that gives that basically gives the farm the maximum. We call it the maximum profit. Gives the farm basically the maximum profit. So what is producer's equilibrium? Refers to the level of output. Basically, we say producer equilibrium is therefore the farm, we say the farm's, is therefore the farm's level of output, is the farm's level of output, Producer equilibrium is therefore the farm's level of output, which gives the maximum, what we call the maximum profit, which gives the maximum profit. And as you can see from the diagram, this is an isocost. AB is an isocost line, and then we have Q as an isoquant. So 3,000 is the level of output that will give the maximum profit. So a farm is said to be, just a continuation, a farm is said to be at producer equilibrium, A farm is basically said to be at producer equilibrium, if there is no scope, if scope is intention, if there is no scope of increasing, we say scope of increasing, the scope of increasing the profit, or reducing the scope of increasing profit or reducing the loss, the scope of increasing the profit or reducing the loss, by changing the output, by changing the quantity, of output, by changing the quantity of output, So if you look at that question, that's question particularly tackling 2 marks, but it's expounded fully. That is the diagram. So at 3,000, that is where we have producer equilibrium. So 3,000 units is the level of output that gives the maximum profit. But you say producer equilibrium is therefore the farm's level of output, which gives the maximum profit, that basically gives the maximum profit. And you say that when a farm is basically at a producer equilibrium, the farm has no scope of either increasing profit or reducing the loss by changing the quantity of output, by changing the quantity of the output. That is how we particularly go through that question. We pick it on the next question, that is question 7, A, Roman B. So the question says, highlight assumptions of the producer surplus. Highlight assumption, that is Roman 2. Highlight the assumptions, what do you call the assumptions of a producer surplus. Highlight the assumptions of a producer surplus. So before we highlight assumptions of a producer surplus, it is very important to understand what we basically mean by a producer surplus. When you talk about a producer surplus, we basically say that there is a difference between the amount the producer is willing to supply good for and the amount that they actually receive when they make the trade, which in most cases we say is an additional benefit, because you realize that what they receive is more than the minimum that they're willing to supply the goods for. So that is actually a benefit. So if you're to draw, that is not of essence, but you can particularly have questions that will tell you to define a producer surplus and draw the diagram. But for this particular question, it has simply asked on highlight 5 assumptions of the producer surplus. When you look at those assumptions, one, we talk about producer is assumed to be rational. basically a consumer is aiming to maximize profit, and we know that we maximize profit where MR is equals to MC. So we say number one, producer. One, we say producer. Producer is assumed to be rational, i.e., we say aim to maximize the profit, aim to maximize profit. We know i.e., at the point, MR is equals to MC. That is basically where the consumer basically aims to maximize the profit. The second assumption is that there is perfect competition. There's a perfect competition market. Number two, we say there is a perfect competitive. There is a perfect competitive. We call it a perfect competitive. There is a perfect competitive perfect competition market. There is a perfect competition market. We know how a perfect competition basically work, and we say that assumed to be perfect, perfectly competitive. Assumed to be perfectly. We say perfectly competitive. Consumer is basically assumed to be perfectly competitive. Then you say that there is free entry and exit. There is a next assumption. There is what you call free entry and exit, i.e., there is free entry and exit, i.e., that is to say that producer can freely enter and exit. Can freely enter and exit as the third assumption. The fourth assumption, basically, we say there is no externalities. There is no externalities. There is no externalities as the next assumption. Basically, we say that there is no externality. That is saying external cost and benefits, external cost or benefit. No external, what you call external costs and benefits. No external cost and benefits. And lastly, assumptions, we say constant return to scale. The fifth assumption, we say constant return. We call it constant return to scale. What do you basically mean by constant return to scale? We know that average cost of production remains constant. Average, that is to say average of the production, average cost of the production remains constant. Average cost of production basically remains constant as quantity produces increases. As quantity produces, as quantity produces increases. As quantity produces basically increases. As quantity produces basically increases. As the quantity produced basically increases. Again, I said at the beginning of that particular question, I said you can be asked what a producer supply as a major area, and you can also be told to illustrate using a diagram how producer supplies basically come. And that is how we particularly handle that question. That is question 7, A Roman 2. That is how we go about that question. We pick it on the next question, that is question 7, Roman B. With the help of a well-labeled diagram, explain the stages of law of diminishing return. We put that question down. With a 8, we say with a 8, we call it with a 8 of a diagram. With the aid of a diagram, we say explain the stages explain the stages of the law of diminishing return. So when you talk about the law of diminishing return, we also call it the law of variable proportion. What does the law of variable proportion basically talks about? We say that when a variable factor of production, that is labor, is added to fixed factor of production, and that is land, we say that total output increases, but at a decreasing rate. The total output increases, but at a decreasing rate. We can illustrate, first of all, come up with the diagram. We proceed to this at the end because this end is a bit small. So we have our diagram on this end. And you talk about those stages. Basically, this law of diminishing return or the law of variable proportion, we have it here. So this is what we call total product at that end. We have the total product. We have this as average product. We have it as average product. Then up here, we have what we call the marginal product. So on this other end, we have total product, marginal product, and average product. And down there, we have quantity. We have the quantity. We illustrate on that point. At that point, we illustrate. So we have what we call stage 1 on this day, stage 1. We have stage 2. And finally, we have stage 3 on this other end. We have stage 1, this is stage 2, and this is stage 3. So basically, when you talk about the law of variable proportion, the diagram is this, and the diagram is basically divided into 3. So we have the first stage, we call it increasing, what you call increasing returns. So on basically increasing return, we're saying that when a variable factor is added, and the variable factor is labor, is added to a fixed factor of production, which is land, total product increase but at a decreasing rate. So what essentially happens in this part is that when that happens, when you talk about TP, we talk about MR, and you talk about AR, are all increasing, all increasing. All of them are increasing. All of them are basically increasing. That is at increasing return, which is stage 1, as it is. That is stage 1. That is what happens in the stage 1. That TP, MR, and AR are all increasing when a variable factor is added to a fixed factor of production, which is land. We have the TP, we have the MR, and AR all increasing. Stage 2, we call it a constant return. So basically, we are saying that when we basically had a variable factor, which in this case is labor, to a fixed factor of production, which is land, we will see that at this particular stage, in as much as probably you can have the total product increasing, we'll see the marginal product. At this point, we'll find the marginal product. If you look at the marginal product remaining constant. Marginal product will have the marginal product basically remaining marginal product at a particular point, marginal product remaining constant. So you'll have a marginal product at one point. Maybe you have between quantities, quantity. You can have maybe a quantity that follows, maybe between 4 and 5. You're having a marginal product, which is MP. This is P, average product, and that. This is average product. Sorry for that. This is marginal product. So we have the total product in the first stage, marginal product, and AP all increasing. The second stage, we are saying that it's called a constant return. What we call a constant return. So on the constant return, we'll have the TP increasing, but you find at that particular stage, MR remain constant at a particular stage. Maybe at a unit of 4 to 5, you find MP, that is the MP, which is the marginal product, remaining constant. So we can have the total product increasing, but you'll find MP remain constant, maybe at 4 and 5. So that is what you call constant return. And then we have the third stage. The third stage. The third stage, we have what we call decreasing stage. So on the decreasing stage, look at the decreasing stage, which is stage 3. This was stage 2. This was stage 2. This is stage 3. This is basically stage 3. So decreasing stage, we can see the total product, we can see the average product, and we can see the marginal product are all decreasing. In fact, the marginal product is negative. So we see TP, AP, and MP are decreasing. So when we add a variable factor, which is labor, to a fixed factor of production, which is land, total product, average product, and marginal product are all decreasing. But we can see also that at that particular point, MP is even getting MP gets negative. Initiating inefficient MP is negative even at that stage. So for the diagram, that question is 6 marks. The diagram will constitute a huge number of marks. If it's 6 marks, the diagram will particularly take a huge mark. The diagram could take even 3 or 4 marks. Then the explanations that we have summarized on this particular point, those will take the remaining marks, which is either 2 or 1, maybe there. But the diagram will basically constitute a lot of the marks in that particular question. The diagram will constitute a lot of marks in that particular question. And that is how we particularly go about that very question. But even on this, we have assumptions of the law of variable proportion, or the law of diminishing returns. The law of variable proportion, or the law of diminishing return. You can have the assumptions. You can be asked the assumption. You can also be asked. On shortcomings or limitations of the law of diminishing return. That is how we particularly handle that specific question. We proceed from the next question. That is question 7, Roman C. Explain 4 monetary policies that the central bank of a country might apply to control inflation. That the central bank of any country might apply to control inflation. So when you look at this particular question on a yearly basis, this is a question that keeps on repeating itself. Even on the 2020, even on the other exams, you find particularly questions that touches on monetary policy is always there. So we put down the question, then we go through the question. So that is to say, explain, one we call explain, 7 Roman C, explain 4, say 4 monetary policies, that a central bank of a country, might apply to control inflation. So I explained 4 monetary policies that a central bank of a country might apply to control inflation. Number 1 is to understand what you call monetary policy. Whenever we talk about monetary policy, we basically call it, these are instruments that are basically used by the government through the central bank to regulate the supply of money. Either the supply of money is high or low. How do you use these instruments to basically control inflation? The first one we talk about is what you call the bank rate. Bank rate, where the first one you call it the bank rate stroke what you call the interest rate. The bank rate stroke what you call the interest rate. So when you talk about the bank rate stroke the interest rate, we know that when the supply of money is high, the interest rate is usually raised to reduce the money supply altogether, or to reduce inflation, and vice versa. So we say that during inflation stroke high supply of money, of money, interest rates are raised. Hence this will control inflation. Hence this will control inflation. Stroke reduces the supply, high supply of money. So the second one, we can talk about what you call open market operation. Open market operation. So when you talk about open market operation, this is buying, what you call buying and selling of the government security. Buying and selling of the government security. And particularly when you talk about the buying and selling of the government security, we're talking about T-bonds and treasury bills and bonds. So we basically know that when there's a high supply of money, that is when there's inflation, the government will basically sell security to the public to reduce the flow of money. So we said during inflation, the government, we say that the government will sell securities to the public in order to reduce inflation stroke high circulation of money. High circulation of money. So we have number 3, what you call compulsory deposit. Deposit stroke reserve requirement. What you call reserve requirement. Compulsory deposit stroke what you call the reserve requirement. Whenever we talk about the reserve requirement stroke the compulsory deposit, we basically mean that all the commercial banks must hold a reserve with the central bank of any country. And we're basically saying that when there is inflation or when there is high circulation of money in the economy, what the banks or the government in relation to the central bank basically do is that they increase the compulsory ratio or the reserve requirement to make sure that most of the money are with the CBK. So we need to say that during inflation, the government through the CBK or the central bank of any country will increase the reserve stroke what you call the compulsory ratio, compulsory deposit, not ratio but compulsory deposit to ensure there is no high circulation. There's no high circulation of money to the public. There's no high circulation of money to the public. There's basically no high circulation of money to the public. And there's no high circulation of money to the public. There's no high circulation. And lastly, we can talk about selective, what we call selective credit control. Selective credit control. One of the reasons why we have inflation being high is that when there's a lot of money in circulation, when there's credit available to all sectors of the economy, then you know that that can lead to inflation, because there will be money all over. There will definitely be money all over, and that leads to what you call inflation. But basically, during inflation, the government through the CBK will do what you call selective credit control, where credit will only be given to a selective sector of an economy, to a selective sector of economy. And that will be basically a productive sector. We can talk about productive, only to a productive sector. We can talk about a productive sector. So when that happens, you know, when you have the credit being selectively given only to a productive sector, this reduces, we'll say that this controls the inflation. This controls the inflation, stroke circulation, stroke high circulation of money, high circulation of money to the public. That basically controls high circulation of money to the public. And lastly, as an additional, as a bonus one, just to understand this deeper, we can talk about what we call the cash ratio. I just explained it, cash ratio. So we know that particularly when there is high circulation, you know, of money in the economy, what basically the CBK, the government through the CBK does is that they increase the cash ratio. That will reduce circulation of money. And hence, by doing that, they reduce inflation. But again, also of essence, of importance is to understand that questions will not only be touching on this. We can have questions that will basically touch on even fiscal policy. So it's important to understand what a fiscal policy is altogether. Apart from the monetary, it is also very important to understand what we basically mean by a fiscal policy. That is how we particularly handle that question. We'll pick it on the last question. That is last question, April 2024, economics, the last question, that is 7 Roman D. Outline 3 measures that developing countries might use to promote agricultural production. Outline, that is D. Outline what we call 3 measures that developing what we call developing countries might use to promote agricultural production, promote agricultural production. So when you talk about this particular question, again, it's also more of a general question. When you talk about factors that foster or promote or encourage agricultural production, we know that the basis, you know, one of the major backbone of an economy in this developing country is agriculture. Still, majority lies on agriculture, not much of the industrialization. So again, I say that this is a very much open question. When you ask such a question, you know, we can say one of it is reduce taxes on agricultural, reduces the taxes on agricultural input. So you make agricultural input, and this encourages production. Then you say adopting an irrigation scheme, adopting irrigation schemes to overcome adverse weather condition like drought. Adverse weather, to basically overcome adverse weather conditions. To overcome adverse weather condition. Adoption of irrigation scheme to overcome what you call adverse weather conditions. And you can talk about developing infrastructure, what you call developing infrastructures in the developing countries, developing countries. I explained particularly this. Why is infrastructure very important? Some of the challenges and why we have not spurred agricultural production in developing countries because of infrastructure. You find the roads, particularly the roads from the industry to the markets, are not very poor. So with that, there are delays in terms of exportation and that. So when you develop infrastructure, that in turn promotes what you call agricultural production. But I say that this is more of a general question. We can talk about a number of things. We talk about investing in research so that you can come up with better quality of products, investing in research. Again, we can also give loans to entrepreneurs, loans to entrepreneurs for those that actually wants to engage in farming massively. The government can offer loans to such. But again, also research is also very important into coming up with better qualities of products in order to invest in. That is how we particularly touch on that very question. That is question 7D, and that marks the end of that paper. Goodbye. We see one another in the next session. Welcome to Manifested Publishers. My name is Mr. Dongo, a PFT, Public Finance and Taxation lecturer. Today, we will be going through August 2024 paper. And we start with question 1. Question 1A, explain the following terms used in public finance management. 1 is the consolidated fund services, and 2 is what we call division of revenue bill. So we come, put the question. So question 1, so A, explain the following terms. Explain the following terms as used in public finance management. As used in the public finance management. So 1 is what A is consolidated, what we call consolidated fund services. So basically when you talk about a consolidated fund, that all government revenue are basically kept in account called a consolidated fund, except the ones that are not approved by the Act of the Parliament. So basically when you say consolidated fund services, we basically mean, we say services means the expenses, we say the expenses means the expenses of which is charged, the expenses of which is charged directly, we say directly against, we say directly against the, against, and you say and payable from the consolidated fund, from the consolidated, we say the consolidated fund, we say under the virtue, we call it under the virtue of the Constitution, Constitution. Under the virtue of the Constitution or any act, we say any act of the Parliament. Any act of the Parliament. Any act of the Parliament other than, we say other than appropriation. Other than appropriation. Other than the appropriation. So that is what we call consolidated fund services. So services basically means expenses which is charged directly against and payable from the consolidated fund under the virtue of the Constitution or any act of Parliament other than the appropriation. So then we have the second, what we call division of revenue bill. Division of revenue bill. When you talk about division of the revenue bill, we're basically talking about how revenue is divided at the two levels of government. That is the national government and the county government. So this refers to, it's a bill that aim at. It's a bill, we say it's a bill that aims at equitable, what do you call equitable? What do you call equitable? Equitable allocation of funds between two allocations to distribution of funds between two levels of the government. Between two levels of the government. Equitable allocation or equitable, just say the word distribution. Equitable distribution of funds between two levels of government, i.e. national and county government. National and the county government. So when you talk about division of the revenue bill, we are basically talking about how revenue is equitably distributed of funds between two levels of government. That is basically the national government and the county government. The national government and the county government. That is how basically we tackle that question 1A. We'll pick it on the next question. We say outline 5 purposes for which national government should borrow money according to the provisions of section 192 of the Public Finance Management Regulation 2015. So we put it down. That is B, question 1B. We say outline 5 purposes. Outline 5 purposes for which the national government should borrow money, for which the national government should borrow money according to the provisions of section 192 we say of the public financial management regulation. We call it Regulation 2015. So basically we are being asked by the examiner the 5 purposes to which national government should borrow money according to the provision of the section 192 of the Public Financial Management Regulation of the Public Financial Regulation of 2015. So basically, national government would borrow money for various purposes. One of it is to overcome budget deficit. One of the very common things about these developing countries, Kenya being one of it altogether, that is majority of the budget, most of the budget cannot be covered by the revenue. So one of the reasons is that they borrow to overcome a deficit. We also have another reason that we can talk about in case of emergency. So we can put them down. We have one, what we call financing the national, what we call the national deficit, financing what we call the national deficit. Deficit when expected expenditure is more than the expected revenue. The second is borrowing for the purpose, what we call borrowing for the purpose of the cash management, borrowing for the purpose of the cash management, borrowing for the purpose of the cash management, borrowing for the purpose of the cash management. Then we talk about honoring. Sometimes you find that the national government would borrow to pay back loans that are due. So we say honoring, what we call honoring, obligations, honoring obligations, under outstanding, what we call outstanding, under outstanding, national government, honoring obligations under outstanding national government guarantees. Then we can talk about the next, what we call refinancing, what we call outstanding debt, refinancing what we call outstanding debt, or repaying, what we call repaying a loan, to its date of repayment. Refinancing outstanding debt or repaying a loan to its dates of repayment. So they can also borrow. We can talk about lastly borrow in case of emergencies. They can decide to borrow in case of emergency. These are basically unforeseen events. So basically this is the reasons that the national government will probably borrow in relation to the provisions of section 192 of the Financial Management Regulation 2015. That is how we basically tackle that question. We'll pick it on the next question. We're being told Section 194 of the Public Finance Management Act of 2012 specify the functions undertaken by the Public Sector Accounting Standards Board. That is PSSB, Public Sector Accounting Standards Board. So with reference to the above statement, describe six functions. We put it down on the board. So that is C. So we talk about section, we say section 194, of public, what do you call the public financial, of the Public Financial Management, of the Public Financial Management Act 2012, of the Public Financial Management Act of 2012, we say comma, specifies we say specifies the functions, we say the functions, specifies the functions to be undertaken, we say to be undertaken, by public sector, by the public sector, what do you call the public sector? Accounting, public sector accounting standards board. Public sector's accounting standards board. Into bracket, that is the PSSB, public sector's accounting standards board. So then you say with reference to the above statement, with the reference to the above statement, with the reference to the above statement, describe, we say describe functions of PSSB. Describe the functions of the PSSB, Public Sector Accounting Standards Board. So number one is to define, to understand what you mean by Public Standard Accounting Standard Boards. It's basically the role. We need to understand that this basically comes from topic 3, that is oversight of the public finance. One public sector accounting standard board is one of the areas of oversight. That is basically one of the areas of oversight when you look at the public sector accounting standards board. And basically in going through these questions, in going through this particular question, it's very important that one of the roles of this public sector accounting standards board is basically to set what we call accepted accounting and financial standards. One of it as a role in the bid for oversight, we call it set. We say set. Generally, what we call generally accepted. Set what we call generally accepted. Set what we call generally accepted. Accounting and financial standards. The word is to set. Implementation is not the role, but basically is to set generally accepted accounting and the financial standards. The next we can talk about prescribing an audit procedure which basically comply with the PFM, what is the Public Financial Management Act. We say prescribe. Internal audit procedures. Internal audit procedure, basically to prescribe internal audit procedure, which comply with PFM Act. So basically, it prescribe internal audit that basically will comply with what called Public Financial Management Act. So we can proceed to the next. That is the third point on that. We say that they set this standard. They don't implement, but basically they set the standard. So the next we can talk about prescribe the minimum standard. What we call prescribe the minimum. We say the minimum. What we call the minimum standard. What we call the minimum standard. Prescribe the minimum standard of what we call maintenance. Minimum standard of maintenance of what we call proper books of account, of maintenance of proper books of account. minimum standards of maintenance of the proper books of account as the next role. Remember, they do the oversight role. And 4, we can talk about what you call publish. What you call publish and publicize. Publish and publicize. Publishing, basically publicize. And you say publicize the accounting. What do you call the accounting? The accounting and financial standards and the financial, what do you call the financial standards and the financial standards. Publish and publicize the accounting and the financial standards and any directives and any, what do you call, any directives, directives and guidelines and the guidelines prescribed by the board. Prescribed by the board. What do you call prescribed by the board? So basically, publish and publicize the accounting and the financial standards and any other directive that is basically prescribed by the board. So we have the next, perform. We can say that is 5, that you say perform any other function. Perform any other function. Function, we say function related. Any other function related to advancing. What do you call advancing? Related to advancing. Prescribe any other function related to advancing. Financial, taking it higher. Financial and accounting. We say financial and accounting. Perform. This is say perform. Perform. We just rub it and write it clearly. Perform. Any other function. This is say any other function related to advancing financial and accounting system. System management. System management. System management. And reporting in the public sector. And reporting in the public sector. And the reporting basically done in the public sector. So perform any other function related to what you call advancing financial and accounting system management and reporting in the public sector. And lastly, we say in consultation. In consultation. We say in consultation. We say in consultation with the cabinet. With the cabinet secretary. In consultation with the cabinet secretary. On the effective, what do you call effective? On the effective dates of the implementation. Dates of the implementation. In consultation with the cabinet secretary on the effective dates, that is cabinet secretary of finance, on the effective dates of implementation of the standards. We have not said they implement, but they consult on the effective dates of the implementation of the standards. And you say, comma, gazette, the dates. We say gazette the dates for application. Gazette the dates for the application of standards. and guideline. Guideline. Again, very important for us to get to understand that when you talk about public sector accounting standard board, that's an oversight. So there are also various levels of oversight, that we basically have in relation to oversight. Also, various areas of oversight, apart from the public standards accounting boards. We have the internal audit as also an oversight. That's an area that can also be examined. So as you look at this, it's also very important to look at other levels of oversight. And I've talked about one as internal audit. And what is the role of internal audit? That is how we basically tackle that very question. We'll pick it up on the next question. That is question 1, Roman D, the last question on 1. So the question says, in relation to the public procurement and asset disposal regulation 2020, outline 5 methods that accounting officer or procuring entity or procuring entity may use to dispose the asset. So we have the question on the board. We say that is D. We say in relation to the public, what do you call the public? In relation to the public procurement, in relation to the public procurement and asset disposal, regulation 2020, regulation 2020, outline 5, we say outline 5 methods, that an accounting officer can, we say, use 5 methods that accounting officer can use, that an accounting officer of we say of a procuring entity may use to procure, may use to dispose asset. May use to dispose asset. So when you talk about disposal, is how we do away with the asset. And when you look at this topic, that is basically topic 4 on procurement. So we are basically being asked that in relation to what you call the public procurement and disposal regulation, that is of 2020, what are the methods that that accounting officer of a procuring entity may use to dispose? To dispose basically is to do away with the asset. What are some of the methods that would basically be used to do away with the asset? One is, we call it a trade-in. We call it trade-in. What do you call trade-in? You can have a new asset and you do away with the older asset. We call it trade-in. That is the first method that we dispose of an asset. So we move to the next. As we wrap this to the end. As we wrap this at the end. As we wrap this to the end. As we wrap this to the end. The next method that a procuring accounting officer of a procuring entity can use to dispose an asset, can basically use to dispose an asset. We talk about sell by public. What do you call sell by public tender? What do you call sell by public tender as another method that can be used to dispose an asset. Then you can also call number 3, what you call sell. We say sell by public auction. What do you call the public auction? Sell by what you call public auction. Sell by the public auction. We also have what you call transfer. Another way for disposal, we say transfer. We can call it transfer to another, what do you call another public entity. Transfer to another public entity, or part, what do you call part of public entity, part of the public entity, with or without financial adjustments. With or without financial adjustment. With or without financial adjustment. We've talked about transferring to another public entity or part of public entity with or without what you call a financial adjustment. And lastly, what you call waste disposal management. What you call waste disposal management. Lastly, what you call waste disposal management. Waste disposal management. Very important for learners to understand that this is also a very crucial topic in the public finance. We need to understand even the role of IFMIS under this, the roles of a number of things. For example, IFMIS in relation to procurement. What are the benefits of electronic procurement as opposed to a procurement that was basically being done physically? What is the role? Pre-qualification of tender. What are some of the pre-qualifications that are required for tender, for the ones that are basically picked for tenders, basically still touching on procurement. But particularly for this, we were basically talking about a number of ways that an accounting officer in a procurement entity may dispose an asset. We've talked about trade-in. We've also talked about sale by public tender. We've talked about sale by public auction, transfer to another public entity or part of public entity with or without financial adjustment. And lastly, we've talked about what we call waste disposal management. That is how we particularly handle that last question. And that marks the end of the question 1. See you in the next class. Welcome to Manifested Publishers. My name is Mr. Dongo, Public Finance and Taxation Lecturer. Today we are going to handle public finance paper, that is August 2024, question 4. August 2024, question 4. August 2024, question 4. August 2024, question 4. So the first question, that is question A, explain the following terms as used in taxation. Explain the following terms as used in taxation. One is what you call duty drawback. Question 4A, Roman 1, is what you call duty drawback. What you call the duty drawback. So when you talk about duty drawback, we're saying means a refund. This basically means, we say means a refund. Means a refund of all or part, or we say or part, refund of all or part of any import, duty paid in respect, we say in respect of goods, exported, in respect of goods exported, or used, we say used in a manner, used in a manner, used in a manner, or used in a manner, used in a manner, or for the purpose, exported or used in a manner, or for purpose, for purpose, or for purpose, purpose, prescribed, we say prescribed, prescribed, purpose prescribed, prescribed, as a condition, we say as a condition, as a condition, for granting duty drawback, for granting duty drawback, for granting duty drawback. So very important we say that when you talk about duty drawback, we basically mean a refund of all or part of duty or part of any duty of any import duty paid in respect of goods exported or used in a manner or for the purpose prescribed as condition for granting duty drawback. So the keyword is refund of all or part of any import duty paid in respect to goods exported. So that is what you call a drawback. The second, that is A Roman 2, we have what you call sufferance, what you call sufferance worth, what you call the sufferance worth, what you call the sufferance worth, sufferance worth. So when you talk about sufferance work, it basically means any place, we say means any place, other than, any place other than, any place other than, unapproved, what do you call unapproved, any place other than approved, approved place of loading, we say loading, or offloading, or offloading, loading or unloading, or offloading or unloading, any other than approved. So it means a place other than approved, a place other than the approved. Approved basically means the one that is recognized for loading and unloading, at which we say at which a commissioner, we say at which a commissioner, may allow, we say at which a commissioner may allow any good to be loaded, or unloaded, to be loaded or unloaded, to basically be loaded or unloaded. So then we have Roman 3. We have Roman 3, what you call import declaration fee. Import declaration fee. So when you talk about import declaration fee, this is basically paid to goods that are imported into the country, basically for home use. Goods that are imported into the country, basically for home use. So we can put it down and say that it is a fee. It is a fee on all goods imported, into the country for home use, into the country basically for home use. So we know that the amount payable is about 3.5% of the goods that are imported. But the keyword is basically when you talk about import declaration fee, it is a fee that is paid on all goods imported into the country for home use. So we can pick the next question, that is B, a calculation question, that is on partnership, a calculation question on partnership, that is B. So the first thing we're being told that there is a worker in Baraka started a partnership business in the year 2022, sharing profit and losses in the ratio of 5:3. So we have two partners, that is Waka, and we have Baraka, Waka and Baraka. So Waka and Baraka, the ratio is 5:3. Then this should be ratio of 8:5. Then this should be 3:8. That is the sharing ratio. That is basically the sharing ratio. So we're being told that the following is a statement of profit or loss for partnership in the year ended December 2023. So we are looking at sales. We know that sales, that should be a taxable income. General bad debts recovery, that is a non-taxable income. We have anticipated foreign exchange gain. When you talk about anticipated, those are not realized, so that's also non-taxable income. We have capital gain on the sale of land. Again, that is a non-taxable income. That is a non-taxable income. Then you have insurance recovery on stolen vehicle. When you talk about insurance recovery, basically on a stolen vehicle, that is also basically what you call a non-taxable. That is what we also basically called a non-taxable income. Then release of liability. When you talk about release of liability, then that is a taxable income. Release of a liability is a taxable income. Then you have interest from Ulinzi Sacco. When you talk about interest from Ulinzi Sacco, that is an investment income. So that is a non-taxable income in relation to the business. And we know that interest from SACCOs, we call them qualifying interest, where we're saying that the 15% withholding tax is final, and therefore we do not subject them to further taxation. Then we proceed to the expenses part. When you talk about the expenses part, we have the purchases. We have purchases, which is an allowable deduction, allowable expense or allowable deduction. Then you have purchase of computers. We call purchase of computers as non-allowable. Purchase of fixed assets are not expenses in taxation, so that is a non-allowable expense. We have repairs expenses. When you talk about repairs expenses, those should be allowable expenses. We have legal and professional fee. So on the legal and professional fee, we basically say that legal and professional fee can be allowable, and at the same time it can be non-allowable. However, if an examiner brings a question on legal and professional fee and there's not an additional information, then that legal and professional fee should be allowable expense. The next is what you call rent and rates. Rent and rate, that should be allowable expense. Then interest expense, we say that interest on partners' capital, that is non-allowable. However, interest on loans borrowed, that should be allowable. So we can look at the additional information. General expense is allowable expense, provided there's no additional information saying something contrary. Motor vehicle expenses, that should also be allowable expenses, provided there's no additional information saying something contrary. Then we have the insurance, that should also be allowable expense, provided there's no additional information relating to anything. Then we have what we call welfare expenses. Welfare, basically, if you have welfare for employees, that should be allowable. Then we have audit and accounting fee. Audit and accounting fee, that should also be allowable expense. Then we have computer softwares and programs. That is a capital expenditure. So capital expenditure, those should be non-allowable expense. Then lastly, we have traveling expense, a figure of 64, that should be allowable expense. So if you look at the totals and we minus from the incomes, the accountant basically got a net loss of 2,750,000, and this needs to be adjusted as a tax person when now we talk about in terms of tax. So additional information, we have legal and professional fee. Total was 816. Out of that, there is a legal and professional fee. The first one, that is legal fee on defense against alleged breach of trade contract. When you have legal fee on defense against alleged breach of contract, those should be allowable. Those are allowable expenses. The next is legal fee on tax appeal. That is a non-allowable, so that needs to be added back. that is a non-allowable expense, which is in the P&L. We need to adjust it by adding it back. We have legal land conveyancing fee. Land conveyancing fee is also what we call non-allowable expense, so we need to add it back. Stamp duty is also non-allowable legal fee. We also need to add it back. Then negotiating a business loan. When we have legal costs that we incur to negotiate a business loan, that we also say that is also non-allowable legal cost. Then we have recovery of bad debts. Legal fee that relate to customers and debtors, that is allowable. That is an okay expense. Then we have signing a 100 years lease agreement. When you talk about lease agreements, renewal and signing of leases, if leases are below 99, then those ones should be allowable. However, if leases are above 99 years, like the one we have in this particular question that says 100 years, then that should be a non-allowable. Then we have purchase of private or partner's private vehicle. That is a private expenditure. So purchase of a partner's private vehicle as a legal cost, that should be non-allowable expense. Then the last one on the legal fee, we have what we call legal fee on renewal of patent. Renewal of patents, that should also be non-allowable expense. So done on additional information 1. So additional information 2, we have repairs expenses comprised of the following. The first expense that relates to repair, we have the purchase of furniture. When you talk about the purchase of furniture, those should be non-allowable expense. When you talk about the purchase of furniture, those ones should also be non-allowable expense. We have what called designing and partitioning of a new block. Designing and partitioning of a new block, that's also a capital expenditure, so that is a non-allowable expense. Then lastly, we have what we call repainting of an old office block. That should be allowable. So that one we don't adjust by adding back. So we move to the to additional information number 3. Additional information 3. So we are told that impairment, 1 is impairment of patent, general expense. Impairment of patent, that should be non-allowable expense. The impairment of patents, that should be non-allowable expense. Then we have provision for general bad debts. Provision for general bad debts, that's a non-allowable expense too. We add it back. Then we have drawing of goods by partners. Drawing of goods by partners, we know for sure that those are non-allowable expense. So additional information number 4, that gives us to our working 1. We can call it working 1. So on the working 1, we're being told that purchases and sales were inclusive of VAT at the rate of 16%. Taxes paid or taxes refunded. Taxes paid are not expenses. That one we need to understand. The taxes paid are not basically expenses. So tax paid are not expenses. Again, we need to understand that tax refunds or tax that are basically on incomes, those are non-allowable. And we need to adjust the taxes on sales by lessing, the taxes on expenses by adding back. So we say that purchase and sales were inclusive of VAT at the rate of 16%. So we have the first one, that is purchase. Purchase, the figure for the purchase is 3,706,000 was inclusive of VAT. So that implies that this was 116%. So what is the VAT that we need to add back that were on purchases that understated the profit? Remember the VAT, we say VAT on purchases understates the profit. So correction is correction, add back. So we get that VAT. So say 16 over 116 times 3,706,000. 3,706,000. 3,706,000. If you look at that, we have 16. We have 16 over 116 times 3,706,000. So we have the figure is 511,172. 511,172.4. We round it to all numbers. So with this one, we are going to add back. So then we have VAT on sales, just on that VAT on sales. So we have the figure for the sales. If you look at the figure for the sales in this particular question, the figure for the sales is 5780. That inclusive of sales, that should be 116%. So what is the VAT on sales? We know that the VAT on sales basically overstate. VAT on sales, we know that VAT on sales overstates the taxable income. The VAT on sales basically overstates the taxable income. So we need to understand that the correction is to deduct. The correction is basically to deduct. So if you say that 5780, 5,580,000 is equals to 116%. What about that VAT that we need to deduct? VAT, which is 16%. So that should be 16 over 116 times 5,780,000. 5,780,000. So we have this. So that is 16 over 116, then times 578. So that should be that VAT that we need to deduct. That is 797,241. 797,241. 797,241. 797,241. So then we get to the next additional information. Working 2. We're being told the closing inventory was valued at 120. So 1.2, sorry, closing inventory value. So the closing inventory value is 1.2. The figure is 1.2. That is the closing inventory value. The figure is basically 1.2, while the opening inventory was valued at 10% of the net sales. At 10% of the net sales. So we can get the value of opening stock. The value of opening stock. So the value of the opening stock was valued by 10% of the net sales. Net sales basically means net of value added. So the sales we have, if you look at the sales is 5,780,000. This is 116. So net of sales, that should be 100%. So net of VAT, net of VAT. So net of VAT, that should be 100 over 116 times 5780,000. So sales net of VAT, we have our calc, and we say that 100 over 116 times 5780. So what do we have? We have a figure that's 4,982,000, 982,000, and then we have 982,000. Then we have 759, 982,759, rounding it to all numbers. So with that we have the net sales. So the opening stock was basically, we were told that the opening stock is basically 10% of the net sales. So opening inventory, we have the opening inventory in that particular question, 10% of the net sales. That's 4,982,759. When you get 10%, there should be 498,275.9. So the opening inventory rounded off to all numbers should be 498,276 to 9. 498,276. That is basically the opening stock. So we're being told that opening stock and the closing stock were both undervalued. Opening stock and closing stock. We say undervalued at 10%. So we start with the opening stock. Opening stock. Opening stock. So this figure, 498,276 is undervalued by 10%, meaning it is 100 less 10. So this is 90%. So what is the undervalue, which is 10%? This is what you call the undervalue. So the undervalue that is 10% should be 10 over 90 times 498,276. For 498,276. So we get the undervalue, which is 10 over 90 times 498,276. So the figure is rounded to all number. That should be 55,364. So when you have 55,364, when an opening stock is basically undervalued, what is the correction? When an opening stock is basically undervalued. Let's have a practical example. We have SP sales, we just say sales 2,000. A practical example, sales 2,000. We have purchases 1,000. We have opening stock 400, and then we have the closing stock 500. So to get GP in this, particularly on this, to get GP, so we have this and this. So we have sales, that should be 2,000. Opening stock 400. Purchases 1,000. Then we have closing stock 500. So when that happens, we have 900. And so we know that when you have 900 there, the gross profit in that case should be 1,100. So if the opening stock in this case is undervalued, let's say we undervalue by 100, 300. What is the implication? What is the effect of undervalue of 100? So that would be now 300 plus 1,000 minus 300 plus 1,000, that is 1,300, minus 500, that is 800 now here. So we have the gross profit rising. So when an opening stock is basically undervalued, the correction is to deduct. It deduct since it overstates profit. Deduct since it overstates the profits. So basically the correction is to deduct since that basically overstates the profit. So the opening stock that is undervalued of 55,364, that should basically be deducted. Then closing stock, we can have the closing stock here. Closing stock at this point. So the closing stock is a figure of 1.2. That was also undervalued by 10, so that's 90%. So the undervalue is 10%. So that should be 10 over 90 times 1.2 times 1.2. When we basically do that, so we have 10 over 90 times 1.2. So the figure should be 133,333. So 133, we have 333, two whole numbers. So when closing stock is undervalued, the effect is that it understates. So we add it back. So it understates the profit, so the correction is to add back. So the correction is basically to add back. So we read the last additional information. Interest include, so the interest, we have a figure of 160 in the paper. The figure is interest, when you talk about interest expense, 166. Interest expense include interest on partner's capital of 120, which was shared according to the ratio. So interest on partner's capital is a non-allowable expense. So we need to note on that additional information, number 6, that 120 is a non-allowable expense that needs to be added back. But you're saying that under what you're going to take under partner's allocation, income allocation schedule, we are going to share this interest on capital based on the ratios. So we can have this working as sharing of interest. Sharing of interest. Interest on partner's capital. Partner's capital. So that's as we call it, we're working through there. So we have worker. That should be, worker is 5/8 times 120. Then we have Baraka should be 3/8 times 120. 3/8 times 120. So we get those figures. So 5/8 times 120. So that should be 75. And we are taking them to income allocation schedule. So the other one will be 3/8 times 120. So we have 45. That's okay. We have that as 45. So that marks the end of those additional information. So required. We are told that compute the adjusted taxable profit of partnership for the year ended 31st December 2023. So that is the first Roman A, B Roman A. So say you worker and Baraka partnership, worker and Baraka partnership. Taxable, what do you call adjusted taxable profit? What do you call adjusted taxable profit for 2023. And we need to understand, because we've been provided with accounting profit, we need to understand that we are going to use the net profit. So we'll say we have this shillings on this. Then we know that in this particular question, we have been provided with an accounting profit. So we use what we call the net profit method. So say accounting loss stroke profit provided. So based on what was done by accountant, it basically said that this business made a loss of 2,750,000. So then we say add back non-allowable expenses in P&L, non-allowable expenses in P&L, non-allowable expenses in P&L. Then taxable, we say taxable incomes not in P&L, and taxable income not in the P&L. So when you look at this, when you look at basically what you have, so we start with the P&L, that is on the expenses. So we have the non-taxable, non-allowable expense that we have for the first one in the P&L, less expenses. We have purchase. We have what we call purchase of computers. We have the purchase of computers. So that's a figure of 216 that needs to be added back. 216. Then we have the next on that P&L. We look at the repairs, no legal fee. Just on that computer softwares and programs. We have computer softwares and programs. So that should be 1.2. Computer softwares and basically programs, that is 1.2. So then we have the first additional information that we have on legal. So we say that legal fee on defense against alleged breach, that is allowable. Then legal fee on tax appeal. We have legal fee on tax appeal. Legal fee on tax appeal, that should be 64,800. Then we have land conveyancy fee, what you call the land conveyancy fee. So the land conveyancy fee, that is 72,400. 72,400. We also had stamp duty. We also say that stamp duty, that should be 36,600. That is a stamp duty. We can have the last one. Negotiating a business loan. What do you call negotiating on this? Negotiating a business loan. That's also non-allowable. Negotiating a business loan, that should be 25,400. That should be basically 25,400. So I hope this is able. This is very visible as we looked at that. So because of some entries that we need to have there, and then we have that. This entry we can wrap that we need to add back. That is VAT on purchases. That is basically VAT on purchases, 511. We need, as we wrap it, we need to put it there. So we have VAT, another item, VAT on purchases. On the purchases, that is 1,511,172. So we go on with where we had signing 100 years lease agreement. So say signing 100 years lease agreement. Signing 100 years, that is more than 99. That should be 128. So we have 128,400. So then we have the next, that is purchase of partners. That is a private purchase of partners. We call it partners private vehicle. Purchase of partners private vehicle. That is a private expenditure. That is 137,400. We have that. Then the last one, we know that legal fee on renewal of patent. Legal fee on renewal, what you call renewal of patents. Legal fee on renewal of patents. So the legal fee basically on renewal of patent. Legal fee on renewal of patent. On renewal of patent, we have a figure of 126. That's a figure of 126. We can clear what you have. We know that we have that figure at the back of our mind. 7. We need to understand that we have it as 797, 241, so that we don't go doing the working again. So then we proceed to additional information number 2. We knew that the purchase of furniture is also non-allowable. That should be 260. Purchase of furniture. Then you have designing and partitioning. What you call designing and partitioning. What you call partitioning of new office. Designing and partitioning of a new office. That's also a capital expenditure. That should be 341. So that is also added back. And that is okay. So we move to the third. Impairment of patent rights. That's non-allowable. What you call impairment. Impairment of patent. What you call patent right. Impairment of the patent right. We have a figure of 120. That also need to be added back. Impairment of patent right. Impairment of patent right. Then provision of general bad debt, also non-allowable. Provision of general, what you call general bad debt. That should be a figure of 208,000. We add that back too. Then we have the last one, drawing of goods by partners. We have drawing of goods, also non-allowable, goods by partners. Drawing of goods by partners. So that should be equivalent to 314. having a figure of 314. Then purchases, we knew that we needed to add back VAT on purchase because that's understated the profit. On the sales, we are going to less. So we're still looking at what items that we need to add back. So we proceed to opening and closing stock that were understated. We know that what we need to add back is closing stock understated. So we say closing stock understated. We say understated. The closing stock that is understated, that should be 133,333. 133,333. Then we have the last one, that is interest on partners' capital. We call it interest on partners. We call it partners' capital. Interest on partners' capital. The figure is 120. Interest on partners' capital. The figure is basically 120. So these are the items that we need to add back. What is the total of those items that are needed to be added back? We have 216. We had it 216,000 plus 1.2 down there, plus 64,800 plus 72,400 plus 36,600 plus 25,400. We have that. Then plus 511,172. 511,172 plus 128,400 plus 137,400 plus 126 plus 126 plus 260 plus 260 plus 341 plus 120,000 plus 208,000 plus 314,000 plus 133,33. Then lastly plus 120. So the figure is 4 million. The items that we need to add back, 014,505. That is 4,014,000 and 14,505. So we go to less. Less, we know that we less non-taxable, taxable operating incomes in P&L, comma, investment incomes in P&L, investment income basically in P&L, and what to call and allowable expenses not in the P&L, not in P&L, and allowable expenses not in P&L. So what are we lessing? Non-taxable operating incomes in P&L, investment income in P&L, and allowable expenses not in P&L. And when you talk about allowable expenses not in P&L, this is basically the investment allowance, because we do not have deposition in taxation. So we move to those items. We look at the incomes. So the first one is general bad debt recovery. So we have general bad debt recovery, general bad debt recovery, general bad debt recovery. So that should be 75, the item that we need to less. Then we have anticipated, what we call anticipated foreign exchange gain. Anticipated foreign exchange gain, 180. Anticipated foreign exchange gain. Anticipated foreign exchange gain. So we looked at that as we So as we rotate that camera to that very hand, because of we have that, So then on those incomes, we also have capital gain on sale of land. What they call capital gain on sale of land. Capital gain basically on the sale of land. That should be 352,000. Capital gain on the sale of land. That is a figure of 352,000. Then insurance recovery. Insurance recovery. Recovery on stolen vehicle. This is recovery on fixed assets, so that's also non-taxable. That is 320. An item that we also need to less. We have release of liability is taxable. We have now interest on from Ulinzi, what we call Ulinzi Sacco. Interest from Ulinzi Sacco. Interest from Ulinzi Sacco. So Ulinzi Sacco, we know that that's a figure of 34, and that is qualifying interest. So we don't subject it. We do not take it to the income allocation schedule. So then we move on those incomes we are sorted, but we know that VAT on sales, that was basically overstating profit. VAT on sales we had 797,241. We noted it up there. Then we have the next item, that is opening stock understated. What we call opening stock understated. So the opening stock that was basically understated, that is 55,364. Then we wrap this and move to the investment allowance. Opening stock understated. So as we wrap that, we now move to allowable expenses that are not in the P&L. So that is basically investment allowance. And this is, to be precise, wear and tear. So we can have the first one. We know that we have computers, We have computers. Those should be under investment allowance at the rate of 25. So that times 25% times 216. The investment allowance on that, 25% times 216. 25% times 216. 25% times 216 times 216. So that should be 54. That should be 54. Then we have the next. On the next was computer softwares. We have computer software. That's also 25% at the rate of 25%. That is 1.2. 1.2. That should be 300,000. That should be 300,000. 1.2, that should be 300,000. And then we have what we call, we have furnitures. Furnitures, we know 10%. Furnitures, we know that should be 10%. So furniture, we had on the furniture that was 260. If you look at that furniture, furniture was 260. So that is 10%. Furniture times 260 times 260,000. That should be 26, the investment allowance. Then we have partitioning. The partitioning figure was 341. We know that partitioning is also 10%. So times 10%, that should be 34, what do you call 34,100. So these are the items that we need to less. So we can get the summation of items that we need to less so that we get the adjusted taxable profit or a loss. So I have 75 plus 180 plus 180, then plus 352 plus 320 plus 34 plus 797, 241 plus 55, 364, then plus 54 plus 300,000 plus 26 plus 34,100. So this gives us what we have as 2 million. So we have 2,227,705 as items that we need to less. So we have the adjusted, what we call the adjusted, Part A adjusted taxable profit or loss for the business. Adjusted taxable profit or loss for the business. So we have a loss, a negative of a negative 2, a loss which is that is a negative. So that is negative 2,750,000 plus 4,014,505. So when you had that, then we less, again we less 2,227,705. So what do you have? Adjusted taxable loss of 963,200. That is adjusted taxable loss of 963,200. So when you adjust it, they got it, accountant got this, but as we adjust it, we know that the loss was basically 963,200 using the principles of tax. Adjusting that, we have a figure of 963,200. So then we can proceed to the next part. We can proceed to the next part. The next part we've been told, allocation of profit or loss. So that is B. We can have that B here. What we call allocation of profit or loss. We stretch as we rotate the camera. We stretch as we rotate to have it on a clean slate. That is basically on this other end, to have it on a clean slate. We have it on the clean slate, but we can just have it on that end. We can just have it on this end. We know that this can be enough. So we have Waka, we have Baraka, we have Baraka, and then we have totals here, and then we have totals on that end. So what do we start with? We start with items that we need to add: interest on capital. So interest on capital, there was a 120 that we were able to divide. The 120 that we were able to divide, as we rotate that camera, we can look at where we did the division or working. That interest on capital was basically 75 for Waka, and Baraka was 45. So we get back and have 75 on this. We have 45 on this. So then now we have a figure of 120. And then we have a figure of 120. Then we have a figure of 120. So then we proceed to the next. Is there salaries to partners? There's no salaries to partners. Is there interest on drawing? There's no interest on drawing. Is there bonuses to partners? We do not have that. So we have a column here. We call it the share of profit. We hold it. Share of profit. We hold it. Share of profits stock loss. Stock the loss. Share of profit stock the loss. We have taxable, operating profit or loss for business. Taxable operating profit or loss for the business that we got from our working. That is basically 963,200. So we have that. So we look there keenly. So this one we call it A. We call this one B, sorry. This one we call B, and this one we call A. And sometimes for this particular question, we were simply having one item, that is the interest on capital. So how do you get the profit of share, which is C? C should be B minus A. So the taxable operating loss. So if you have a loss of 963,200, and then you minus 120. So when you minus 120, we mean that there's a loss that needs to be shared. That loss is 1,083,200. How are they sharing it? As I do the working here, how are they sharing? I do the working here as the camera is being rotated. The ratio is still the same. Even that loss is supposed to be shared. So we have worker Waka, and then we have Baraka. Waka is having 5 over 8, and the total loss, as we rotate that, the total loss is 1083 200. So how much loss goes to Waka? Then Baraka is 3 over 8, 10083 200. How much loss goes to that? So we get that. So times 5 over 8. So the loss that goes to Waka, that should be 677. That should be 677. The loss that goes to Baraka, that is 83 200 times 3 over 8. So the loss that goes there, that should be 406. This should be 406 200. So we have that loss that basically goes to this. So this should be 677, 677, 677. Then we have 406, 406 200. So what is the taxable operating income that goes to Waka? We remember, under partnership, we do not tax partnership, but you tax basically individuals that are in partnership, So 75, which is a positive, minus a loss that is 677. So what do we have? We have a loss that is 6, that should be 602. That should be 602. That is, and that we also have a loss. The loss is bigger than the positive value. So if we take 45, so the loss basically decreased to 361, 200. So add, we just say add other taxable investment income. We do not have those investment income. There's none. So then we just wrap this again. We get the total taxable. We wrap that to get the total taxable income. Total taxable income. So we have Waka, Baraka, and then we have the total. The figure remains the same. So that is 602. That is a loss. That should be 361, 200, which is a loss. So the total loss we know is 963, 200. When that is added, 963, 200. So we cannot, in the first place, we cannot tax even these persons because they're making a loss. They're making a loss. In the first place, we cannot tax partners. The partners, we say we do not tax partnership, but we tax individuals that are basically in partnership. That is how we basically tackle that question. That is question 4. But again, a point of essence, when you're doing these particular questions on calculation, remember it's the entries that count. So a student needs to be very careful and make majorities of entry. I always say that if you can make 75 to around 100% of the entries, you stand a better chance of doing very well in this calculation. And also just to encourage that these calculations are doable and that the perfect way is that students can basically score marks. That is how we basically sort that question 4, and that marks the end of the session that we have. See you in the next session.
Hello learners, and welcome to Manifested Publishers online revision classes. My name is Nicholas Sikali. We want to continue the revision by going to question 4 of financial reporting, August 2022. Now the question had 2 parts. There was part A and there was also part B. We are going to start with part A, then we'll proceed to part B. So the question reads, on 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for a 3-year period. The terms of the lease were that Breakwood Limited was to pay 500,000 shillings each year, with payments commencing on 31st December 2019. Initial direct costs incurred on the lease amounted to 30,000 shillings and were paid for by Breakwood Limited. The plant and equipment had a remaining economic useful life of 5 years at the inception of the lease. The lease contract did not contain any purchase option for the lessee. Breakwood Limited can borrow at a rate of 10% per year. Required: analyze the accounting treatment of the above lease transaction from inception for the 3-year period of the lease contract. So this question is concerning IFRS 16, which talks about leases. Remember, this was transited from IAS 17, which also used to talk about leases. But now, according to the subsequent or the amendment that were done, now we'll be following the requirements or the requirements of IFRS 16, that is leases. Now, to account for this lease from inception, that means that we are supposed to, 1, compute the lease liability, and 2, we are supposed to compute the value of the right of use asset. Remember, according to the provisions of IFRS 16, a lease will be accounted for as a finance lease unless the lease is of low value. So if the lease is of low value, then it will be accounted for as an operating lease. But otherwise, all leases will be accounted for as finance leases. So workings. And our first working, we want to get the lease liability, which have not been given here. Lease liability here will be the annual lease payments, that is the lease payments times the present value interest factor of annuity R% n periods. That means you take the annual lease payments and discount them back to the present by using the present value of annuity. Remember, we are using the annuity because the lease payments are made at shillings 500, which is constant per annum. So we are going to use the present value interest of annuity. The annual payments, the lease payments were 500. That is to be multiplied by the present value interest factor of annuity. We were given the discounting factor or the borrowing rate, which is 10%. So that will be computed by taking 1 minus 1 plus 0.1 raised to power negative 3, because a period of 3 years. Then we divide that with the R, which is 0.1. This will give us the lease liability, and the lease liability will amount to the following, and that is 500,000 times 1.1 raised to power negative 3, 1.1 raised to power negative 3, 1 minus answer, divided by 0.1, which is 2.48685. Can use with 85. That will give you a lease liability of 500,000 times answer 425,425,495.995. So that is the lease liability at inception, which follows up with the computation of the right of use asset. So how do you get the right of use asset? Right of use asset. So with the right of use asset, this will be the computation for the right of use asset. Now we start with the lease liability. The lease liability, and the lease liability amounted to 1,243,425.995. Add, from that we want to add the initial direct cost, initial direct cost, and the initial direct cost amounted to 30,000. So 30,000. Before we get the total, you are supposed to deduct any lease incentive, less any lease incentive if given. Any lease incentive, this one is nil, so we were not given any lease incentive. Then this will be the right of use asset. The cost of the right of use asset will be what will be given here. Right of use asset. Right of use asset. Now the right of use asset will be what you have plus 30,000, and your right of use asset is 1,273,425.995. That is the value of our right of use asset. So once we have the right of use asset, and you also have the lease liability, our next option is to see how they are accounted for at inception. So we want to see how they are accounted for at inception. Accounting treatment at inception. Accounting treatment at inception. Accounting treatment at inception. That's accounting treatment at inception, which means that we will be debiting a few things and crediting others. So with the right of use asset, of course, you debit the amount, debit right of use asset of use asset. We are debiting the right of use asset, and the amount that you are debiting that is maybe we are debiting it with 1 million, or because of space it has come up with a more clearer way. So debit and credit. So we have right of use asset, right of use asset. We are debiting 1,273,425.995. You debit the right of use asset with that amount. Then what are we crediting? We are crediting one, bank. There's amount that was paid in bank. The initial direct cost of 30,000. The initial direct cost of 30,000 will be credited. Then you also credit the lease liability. Lease liability. The lease liability amounted to 1,243,425.995. So that is also to be credited there. So if you, at inception, that is the first thing that they did, they debited the right of use with this amount. Then they credited bank because they paid initial direct cost of 30,000. Then you also credit the lease liability of 1,243,425.995. If you add these two, of course, this journal will balance. That is accounting treatment at inception. Accounting treatment at inception. What follows is subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent measurement. And according to what the IFRS presents or provides, after the initial treatment at inception, then the second thing is that the right of use asset will be depreciated annually, of course, on the stated method here. Then another thing that will be happening subsequent to the initial measurement is that the lease liability will have to be amortized. So we'll be doing the amortization schedule so that you can see how the lease liability will be amortized. But before that, let us calculate depreciation. Depreciation per annum is going to be as follows. We have the right of use asset amounting to 1,273,425.995. Just divide that with 3 to get your depreciation charges per year. That will give you some answer. That is 273,425.995 divided by 3. Depreciation per annum is 424,475.33. That is 0.33. 475.33. That is depreciation per annum. So that is 1273,425.995 divided by 3. It's 475.33 and perhaps 17 at the end, but it can stop there for that thing. That is depreciation that will be provided annually. When we have the amortization schedule, we also want to do the amortization schedule. Amortization schedule, because we said subsequent to the initial measurement, the asset will be depreciated, then the lease liability will be amortized. So the lease liability will be amortized. So this will be this way. And we have a long schedule here. Very long schedule for 3 years. So here, 1, 2, 3. So we have 3 years. Perhaps should have that for 3 years. 3 years. So here, opening obligation. Opening obligation. Opening obligation. We have finance cost. Finance cost. We have installment. The annual installments paid. We have principal. And finally, we have closing obligation. Closing obligation. So we have closing obligation, we have principal, we have installment, we have finance cost, and we have opening obligation. For installment, this one has been given as 500 through 500,000, 500,000, and 500,000. That is constant for installment. The beginning obligation of the lease liability, is 1,243,425.995. So finance cost is at 10%. Finance cost is at 10%. So 1,243,425.995 times 0.1. That is 124,342.59, and principal will be 500,000 times answer. 500,000 times answer that you have here, 375, 657.4005, that is 0.4005. The closing balance is the opening balance, of course, minus the closing balance, minus the principal, that is 1243, 425.995 minus the answer 867, 768.59, 768.59. So that will be 867, 768.59, because the other one is 45 on the other side, times 0.1, which is 10%, 86, 776.859.859, then 500,000 minus that answer, 413, 223.14. So 413, 223.14. Then we are going to take 867, 768.59 minus that answer. You get 454, 545, 545.44, 44 cos 95, so 454, 545.44, it is 95 on the other side, 4495 times 0.1, we get 45, 454.54, it is 0.54495, I've abbreviated that. So 500,000 minus the answer to get the principal, which is 454, 545.45, 454, 545.45. And looking at what we have here to get the principal, that is usually opening obligation minus principal to get the closing obligation. If you minus this with this, the answer will be 0, that is 454, 545.45. If I round this one off, it will be 0.45 minus answer, it is 0, and the answer here will be 0. So that's how we run amortization schedule for a loan where the payments were being made in arrears. Remember here, the payments were being made in arrears and not in advance. According to what we had in the question, the payment occurred, or the first payment occurred on 31st December 2019. Remember, the financial year started on 1st January 2019 when the lease started, but the first payment was done on 31st December. That is payment being done in arrears. If payment are being done in advance, that will be a different story. The amortization schedule will change slightly if the payments are being made in advance. Once you've amortized, we now want to move to our financial statement extracts for the 3 years. So the financial statement extract for the 3 years, that will be Breakwood Limited, Breakwood Limited, Breakwood Limited, financial statement extracts, or statement of profit or loss extract. Statement of profit or loss extract for the 3 years, that is 2019 2019, 2020, and 2021. The financial statement extract for those 3 years. The first thing will be depreciation. And of course, the other thing that they will present will be finance cost. Depreciation and finance cost. So we have depreciation and finance cost. Looking at our schedule, we have finance cost. Looking at our depreciation computation, we can bring in 424, 475. 475.33, that will be constant, or can just use 424, 475.33, again 424, 475.33. That will be our depreciation for the 3 years, 2019, 2020, and 2021. That means we'll be debiting depreciation, of course, and we'll be crediting the asset or accumulated depreciation. Finance cost from our amortization schedule, this is 124, 342.59 for the first year. For the second year, which is 2019, that is 86, 776.85. Remember, second year represents 2020, first year represents 2019. The last one is 45, 454.54. So that will be what will be presented to the statement of profit or loss for those specific years. Since it's an extract, there will really be no need of summing them up. That is, if a summation is required, then you just sum them up and get the totals. Breakwood, again, Breakwood Limited, statement of financial position. Statement of financial position extract. Statement of financial position extract, again for 2019, 2020, and 2021. That is the statement of financial position extract. We could differentiate the two. So we go to the statement of financial position extract. The first thing is non-current asset. The non-current asset, we have the right of use asset. Right of use asset. Under the right of use asset, we computed the value for the right of use asset in our workings there to be 1273, 425.995. That will be the same through. This is 1273, 425.995. Same thing to the far end. Maybe I should round them off so that they can fit on them on my board, or 1,273,425.995. So that will be for my 2021. Accumulated depreciation. Accumulated depreciation. Accumulated depreciation. We have calculated depreciations here. 475.33, and for the second year it will be 475.33 times 2. This is 848. 950.66. What if we multiply with 3? It is 1,273,425. 0.99. So that will be depreciation, accumulated depreciation, which will be deducted. This is 0. That one should be 0. This is 425 or 424, 475.33. Of course, this one will be 848, 950.66. So we are deducting from what we have below here. This will give you your net book value for the right of use asset. So this will be net book value. Net book value for those right of use assets. Once you have the net book values for the right of use assets, we move to non-current liability. Non-current liability. And we also move to current liability. Current liability. Current liability. Of course, we have the lease obligation. Lease obligation. And we also have the lease obligation. Under each, of course, the lease obligation at the end is divided into the non-current liability portion and also the current liability portion. Now, looking at our amortization schedule, the liability for 2019, the lease liability for 2019, the total lease liability for 2019, which is year 1, amounted to 867,768.59. That is the lease liability for 2019. If you are presenting it as one figure, obligation just for one figure, that means we'll be using 867,768. But it's usually a very good practice to separate this obligation at the end of 2019 into two portions. That is the current liability portion and also the non-current liability portion. Now for the current or non-current liability portion, the 867,768.59 is made up of two portions, the non-current portion and the current portion. This figure is made up of the principal here of 2020 and the closing balance here of 2020. That means when you take this and you add to this, you'll be getting the 867, which is the obligation for the year 2019. So if you want the non-current portion, you move a year down, and you want the current portion, you also move a year down, which means that you are going to use 454, 545, 545.44. The current portion will be 413, 223, I believe that one was 0.4 as well. That one was 0.4. If I'm not wrong, that was 0.4. If you add these two, you are going to get the obligation. That was 0.45. 0.45. You are going to get the obligation up here of 867,768. The same case for 2020. The total obligation for 2020 is 454,545.44. That is for 2020, presented by year 2 here. 454,545.44. That is the total obligation, which is divided into two portions, the current portion and the non-current portion. So the current portion is the principal, while the non-current portion is the closing obligation. So we don't have the non-current portion because it's 0, while the current portion is now 545.45. Can see, if you add this plus this, you get the obligation for the year 2020, which was the total of 545. Now there are those who will present as one figure. That's just a lease obligation as one figure, and if that is the case, then it means for 2019 you bring a lease obligation of one figure, of 867. For 2020, one obligation for lease liability of 545. Then for 2021, there will be no lease obligation since you have 0. But it's a good practice to always separate them into the current portion and the non-current portion. For 2021, there will be no lease obligation. As we can see, it is 0, and therefore it means that there will be no lease obligation, whether non-current or current in the 2021 year. So that is how part A of the question was supposed to be handled, and we've shown the accounting treatment at inception. Then we've shown for the 3 years the subsequent measurement in terms of depreciation and amortization schedule, how that is going to be reflected in the financial statements for Breakwood Limited, who was a lessee for that matter. We'll now be proceeding to the second part of the question.
Yes, welcome to our revision series. Last we were looking at question 2, the whole of it, and as I said earlier, we emphasize the areas which is still retained in the syllabus, and for that matter, question 3, the 2 sections, we are not going to deal with them because question 3A dealing with simulation and modeling is not there in the syllabus. Question 3B is the solution printout from the computer softwares, which is dealing mainly with sensitivity analysis on linear programming. We are supposed to get the basic of actual working of simplex. So that one also we omit. Instead, we look at question 4A, which reads, enumerate 8 applications of quantitative analysis in business. Enumerate 8 applications of quantitative analysis in business. Now, first of all, that is question 4A. Quantitative analysis is a process of collecting and evaluating measurable data such as revenue, wages, stock shares, etc., in order to determine their behavior in the long run. So that is the ideal reason why we have it's a process of collecting and evaluating. So you see, measurable means we are talking about numerical values, and that is what we have. So the first case that we look about here is we talk about the process here in project management. We are supposed to enumerate, so I can write them down and then explain. When you talk about a project comprises of series of activities. For example, you want to put up a factory. You want to put up a machine, even a posho mill. You have to evaluate what is the likely return from this my posho mill. That is, from the start, you have what we call capital investment. How much is the machine or posho mill costing, and so on. So the project management is that, in this case, what's the likely returns for my portion meal first year, second year, and so on. That is what we'll be calling project management. Even if you talk about putting up a rental building, you must have first incurring the capital cost there. What's the likely return for my business? How do I reschedule whatever I have that I have now to put up a building? Instead, maybe portion meal. What can I do? Portion meal might give me quick return or that. That is, in terms of computation, we apply quantitative analysis for that. That is one aspect where we can apply the quantitative analysis in business, because even if you have plots and the rest, these are business entities which will generate income for an individual, so they are helpful in business. Number two, we have this one in the production management is one area. You know, production means that we have to talk of the so-called the inputs and the output. The raw materials, how many bales of cotton lint are needed for this case to produce an output of a given kind of shirts, which are cotton or what. So that is what we call production management, because for every production, there is always what we call input and then output. Therefore, in quantitative analysis, we have that particular topic which is referred to as input-output analysis, so that you can find how much raw materials are required to produce a specific output. That is production management, and we are deploying the skills of quantitative analysis, raw data and the output, raw data and the results. Remember, there is also the cost, because for you to have raw data, you acquire them from another sector. Therefore, this input-output analysis purely deals with the inter-sector relationship. How much do I depend on the other for me to produce? That is production management. Next, we have marketing. Now, in marketing, you have to purely handle the area of taste. You have heard several times whereby we have people have to go and advertise. The purpose of advertising is simply to find how much is the advertising impacting on actual sales. For example, if I talk about putting an advert for a sale of, say, cooking oil, how much do I have to spend on this particular item, and how much do I actually realize at the sale? The major idea here is to employ the idea of correlation. So the correlation will tell you whether you are spending more on the advert and also the actual sales are also more. That will show you that there is positive correlation. If there is no positive correlation, then it is pointless to do extensive advert, because at the end of it, you may not do or realize your expenditure in terms of income. So what I'm saying is that under quantitative analysis, we have various sections that will be useful to analyze and apply to various sectors, because now for the marketing, you need to know how much is the advert affecting the actual sales. How much, for economists, is the savings connected to income, so that you can see how is the economy stable or what. That is still under correlation, and if by extension you can now talk about regression. All these are now for focusing purposes. But remember, we are talking about marketing. How much do people prefer our bank? as you are a bank manager, we have marketing department, any other Safaricom, the service industries, all those are related. So we have marketing also deploying the skills of quantitative analysis. The fourth one we have here is what we call finance. You know, finance sometimes is difficult to that. So accountants use different quantitative methods to do forecasting, because if you talk about projection in the companies, then you have acquired an asset. So the accountants can use the techniques like the rates of interest to do discounting. Discounting will actually help you to determine the actual return of this particular kind of project. Just remember, we talked about production and the other side project, but the discounting factor, the knowledge of discounting factor, rates of interest that is actually available should be able to assist the finance or accountant in determining the viability, because we have the viability will be having that what we call net present values and the rest. These are out of discounting factors, and therefore they are quantitative in nature for their computation. They'll have the finance section, and therefore we say that quantitative analysis is applicable to finance section and can be used from the particular area of discounting in terms of returns of investment. Therefore, finance utilizes the quantitative analysis techniques. The fifth one would be for personnel management. This one is where we talk, currently we don't talk about personnel officer, but we talk about HR, human resources managers or officers. They need to know how much do we need to retain, how much people, how many employees, the staffing for that matter. Now, if you look at the quantitative analysis, areas such as Markov analysis, Markov will show that how much do you have as exit. You know, in employment, we have exit and entry. How much do we have as exit? How much do we need to retain as a stable staff size? So that for every exit, due to maybe retirement, dismissal, sickness, and the rest, how much do we need to employ? Therefore, under the skills of Markov analysis, the HR people department can determine the stable size of staffing, and if possible, even upward mobility by training them or what we call capacity building. Therefore, it is important to note that even personnel management, which is particular human resource management, employs or applies quantitative analysis technique. It may not be all that simple, but in general, we know that, for example, right now, the government is not employing, or in particular, if say Teacher Service Commission, each and every year there's always a fixed number advertised for a teachers, secondary school and primary school. In effect, the size of labor force to TSC remains the same, round off around 300,000. So which means, what's the plan for the exit and what's the plan for the entry? That is, in particular, area of Markov analysis, that is quantitative analysis coming in. Now, the other one I can talk about is agriculture. Remember, they are using tools which are mainly quantitative in nature. So, when we talk about agriculture, the farmers can use decision theory in that we can now see what are the prevailing conditions. We are here in the month of September. What is the prevailing condition? In this case, as a farmer, do we have adequate rain? And if so, with that assumption of the flow of adequate rain, the farmers can adequately determine the kind or the right crop to plant, given the fact that if you're in short rain season, there are certain plants that may require only short rains or little rain for that matter to mature up. So the knowledge of decision theory, and in particular maybe the states prevailing long rain, unfortunately because of the climatic changes which are experienced all over the world, it has become very difficult to predict how much rain we expect particular point. But what we are saying, in a normal circumstance, if farmers would be able to determine the prevailing condition, they can predict and forecast the kind of crop to put up based on prevailing conditions, weather, as well as their ability, which is the strategies as how do I need labor force or farm machinery, all that they can help. Finally, we have this, this is not final, but I have this 7. I can have this area, what we call the purchase and inventory. This would be under what we call inventory planning and management, purchase and inventory. Now you see in the operations of production, there is always the acquisition of raw material, there is the time, the lease, or whatever we need. Now, with the knowledge of quantitative analysis, I think the farms can be able to determine how much to stock, how much to acquire, or how much to order, and how much it will cost. So all those management control and inventory control, they'll be utilizing the techniques of quantitative analysis, and for that matter, it is important that inventory control or purchase or procurement, they require the knowledge of quantitative analysis. And the last one is, we call it research. We call it research and development. Research and development. Now, what are you saying? That managers can use mathematical techniques to determine eventual profitability in certain inputs, or what we call managers can actually determine the profitability of new products, may say in the market, in terms of probability of their success or failure. So with this, you can now see how much can we now develop for this kind of product, because if we talk about maybe a new kind of maybe like the consumer industry, we have various kind of goods, be it in the cosmetics, be it in the cooking area, be it in the textiles. All this with the probability of success, the research can be conducted and predict what kind of item you can engage it. And therefore, with this, among others, remember the various techniques, even regression, correlation, and linear programming, they are all these, because in linear programming, we talk about personnel management under what we call the assignment problems, and those ones, those not in the new syllabus, but then they are all coming, personnel management still under Markov and even assignment, they're all under the quantitative analysis areas. So for that matter, these are the summary of various areas in which we can apply the quantitative analysis. And that is all we have. Thank you very much. As I said, we are handling only that question 4A. Question 4B, we are not looking into it because dealing with game theory. And question 4C is dealing with the queuing problem. The 2B and C are not actually retained with the current syllabus. For that matter, we are not going to do those questions. We only have to handle question 4A, which was enumerate 8 applications of quantitative analysis in business, and that is 8 marks. So we stop there for that question and move on to the next if there is any other that will still be retained in the current syllabus. Thank you very much.
Welcome to our today's session. Today we are looking at question number 3, Management Accounting, April 2022. Question number 3 reads, discuss 4 challenges that you are likely to encounter when installing a cost management system. So what are the challenges that one can encounter when installing a cost accounting system? Remember, you need to understand the qualities of the cost accounting management system for you to know the challenges that are likely to be incurred. But I'll go straight to answer the question. This is question number 3, part A. Challenges to be encountered. 1, you may have lack of support from the top management. 2, lack of cooperation from the staff. 3, we have changing environment. And number 4, we may have difference in lines of authority. So we were required to discuss 4, but I can give 5. Lack of clarity of objectives. So the main motive or intention of a cost management accounting system is it must be relevant and therefore be able to provide relevant information which the management can use for decision making. But when the installment process begins, there are some times when that process may have challenges, and some of the challenges is we may have lack of support from the top management. It is the top management that can facilitate or ensure that the installation of that system is done in the proper way, and again their support will ensure that the other staff also cooperate so that the system is installed effectively. So if we have lack of support from the top management, it may be a challenge during that process. The Roman 2, lack of cooperation from the staff. Sometimes if that installation of the system is something that maybe is to bring some changes, some staff may resist that change, and when they resist that change, they will not cooperate, and therefore, like when it comes to training, they may not be ready for the training, and it will drag the process of installation. Then changing environment. Sometimes we may have technological changes within the economy. Sometimes we have some systems that may become obsolete after a very short period of time. And because of that, when we are installing the system, you may not be able to detect, like it's a factor that is beyond the control of the installer to know whether we'll have future technological changes or not, which is a challenge. Then number 4, difference in lines of authority. This happens where we have people that are engaging in the process, but they have to report, or reporting is to different authority or authoritative people who have to ensure that ABC is done, and if you do not know your line of authority or where you are to report to, or maybe we have long procedures, then they may delay installation of that system. Then finally, we have lack of clarity of the objectives. What is that system meant for? You need to understand that for you to ensure that you make that system to match with the main objective of the business. So if there are no, if there is no clarity, then you may not be able to tell if that system will be a proper one. Then part B of the question, you are told that the following information is derived in relation to Baridi Co Limited. The annual demand of its product, branded D, is 30,000 units. The ordering cost per order is 2,500 shillings. The holding cost is expressed as a percentage of the purchase price at 20%. The following price ranges are given with their respective quantities. So you've been given a table showing the range, the quantities, and the price. And the question is, advise the company on the quantity to purchase. So again, to answer this question, we have different approaches that we use to advise the management that wants to buy a quantity that is above the economic order quantity. And therefore, when you look at this question, it is simply referring to a multiple price approach. So it is not a one price approach, but it is a multiple price approach. And therefore, how do we advise the management where we use multiple price approach? The first step is calculate the economic order quantity at the current situation of that farm. So we need to calculate the economic order quantity of that farm before we incorporate any quantity. So how do we calculate economic order quantity? Simply the square root of 2DC naught over CC, where D is the annual demand. So this will be equal to the square root of 2 times. D is referring to the annual demand, and we are told that the annual demand of its product is 30,000. So multiply that by 30,000. CO is referring to the ordering cost per order. You are told that the ordering cost per order is 2,500. Then divide by. CC is referring to the carrying or holding cost. And you are told that the holding cost is expressed as a percentage of the purchase price at 20%. So we are to get 20% of the purchase price, but you've not been given the purchase price. But if you look at that table, we have range 1, quantities 1 to 3,000, and the price is 21. So where no discount is given, it means that the goods will be purchased at the original price, and therefore to know the purchase price is from that range where the farm is buying between 1 to 3,000 units, and that is 21 shillings. Then simply solve it. When you solve this, you'll get 5,976 units. So this is the current economic order quantity at which the farm is placing orders. Then you also need to calculate the total cost. How do we calculate the total cost? Total cost equals annual demand. It is annual demand, so I'll give the formula D over Q times CO plus Q over 2 times CC plus PQ. So D is referring to the annual demand, Q is referring to the order quantity. For our case, the order quantity is the economic order quantity, and then CO is the ordering cost per order. So when you take this, is the same as number of orders times the ordering costs per order plus Q is referring to the order quantity divided by 2, which gives us the average stock times the holding cost per unit per annum, then plus the purchase cost. And the purchase cost is simply the cost of acquiring the product, which is simply the price per unit times the quantity. So to substitute this with figures, we'll have 30,000 units divided by the EOQ, which is 5976 units, times the ordering cost of 2,500 shillings plus Q is the order quantity of 5976 units divided by 2 times the holding cost, which was 20% of the purchase price. So this is 20% of 21. Plus the purchase cost is annual demand, which is 30,000 units. We multiply by the price per unit, and the original price is 2021. Then we solve that. This is 12,550 plus 12,550 plus 630,000. So the total cost will therefore be 655,100. So that means that if the firm is to buy without considering any discount, then this is the total cost that it incurs when it is buying 5,976 units. So that's the first step to consider. Then the second step is consider the lower class boundary. Looking at that table, you've been given the quantities, which is in units, 1 to 3,000, we have 3,000 and so on. So our intention is to ensure we advise the management. The firm is already buying 5,976 units. So meaning we are to disregard all the other quantities that are falling below 5,976 units. And I'm saying that we consider that by looking at the lower class boundary. So meaning the other quantities will remain with is range 4 and range 5. This is at 7,001 and at 9,001. Those are the quantities that are above the current EOQ, and those are the ones we want to base on, so that we are disregarding all the ranges from number 1 to number 3. So once you have identified the ranges, we are to calculate the total cost at range 7,001 and at range 9,001. So beginning with at 7,001, total cost will be equal to, the same formula is applying. We have D over Q times CO plus Q over 2 times CC plus PQ. And so the annual demand, according to the assumptions, is it remains constant. So it is 30,000 units. Divided by the order quantity in this case is 7,001 times the ordering cost, which remains constant, plus order quantity In this case, which is 7,001 divided by 2, carrying costs are 20% of the purchase price. So when you look at that range, the purchase price is not 21, but it will be 20% of 15.5 plus the purchase cost, which will be now 30,000 times the purchase price of 15.5. Then you calculate. We have 10,713 plus, these are shillings plus. So this will give us 10,852 plus 465,000. Therefore, the total cost at that point will be equal to the total 486,565. So at 7,001, that's the total cost. We do again for 9,001. The quantity is remaining, that's 30,000 over 9,001. These are units. Plus plus 9,001 divided by 2 times 20% of the purchase price. At that point, the purchase price is 13 shillings. 13. Then plus the purchase cost, which is 30,000 multiplied by 13 shillings. Again, you get the total. This will give us 8,332 plus 11,701 plus 390,000. Therefore, the total cost will equal 410 and 33. So we want to advise the management. So which advice do we give? The advice is the firm should buy. We are comparing the total cost at the current situation, the total cost at order quantity 7,001 and the total cost at order quantity 9,001. Where are the minimal costs? So we advise the firm to purchase the order quantity that will enable them to make a saving. And according to this, the lowest cost is at order quantity 9,001. And therefore we give advice. Advice is the firm should purchase the order quantity, the order quantity 9,001 to 10,000 units. So this will enable the firm to save. How much will it save? The difference between the cost, the current total cost, and that which we are advising it to. So that is 655,100 minus 410. It will be able to save 245,067. So that's the advice we give. Then we proceed on to part C of the same question. You are told that SICK Plastics Limited manufactures plastic components for water pumps. The following budgeted information is available for 3 of their key plastic components. So you've been given the selling price, direct materials, direct labor, we have units produced, and then additional information. Note number 1, the total number of units of each of the 3 products for the period are as follows. We have product X, W, X, and Y, number of purchase requisitions, and then we have number of setups. Then note 2, overhead costs have been analyzed as follows. Receiving, inspecting, quality assurance, the amount is given. Production scheduling, stroke machine setup is also given. Then required, determine the budgeted profit per unit of each of the 3 products using activity-based costing, or the ABC method. ABC method is where we believe that we have activities in an organization that causes costs to be incurred, and therefore we identify the activities causing costs to be incurred, we group them together into what we refer to as cost drivers. And then any activity that is causing that cost, the costs that are being incurred are now put together into what we refer to as cost pools. And so we are to use what we refer to as cost driver rates rather than the absorption rates that we use in the traditional method. So the method we are required to use is the activity base. How do we go about that? Step number 1, we are to calculate the cost driver rates. How do we calculate cost driver rates? This is simply equal to overhead cost, and we divide by the cost driver. So remember, the cost driver is an activity that is causing the cost to be incurred. So we have the cost drivers that have been given. Number 1 is number of purchase requisitions. So we have number of purchase requisitions. To calculate that, note number 2, we have overhead cost. So you will simply take 1,400,000 and you divide by the number of purchase requisitions, and remember you compile for all the products. So we'll have 1,200 plus 1,800 plus 2,000. This will give us the cost driver rate. This is 280. That is per requisition. 280 shillings per requisition. The second one is number of setups. This will be equal to 1,200,000. Divide that by the total of the number of setups for all the products. And this is 1,500 per setup. That's step number 1, calculate the cost driver rates. So once we have calculated the cost driver rates, we now calculate the total costs. And we are calculating the total cost based on the ABC costing system. So we calculate the total cost. We have product W, X, and then Y. So we begin with the direct materials. Direct materials. Direct materials the unit cost is 50 and the units that were produced were 10,000. We have direct materials. This is 50 shillings times 10,000. This will give us 500,000. This is for W, we have for X and for Y. For W, we have 15,000. This is still on direct materials. 15 times 15,000 units. This will give us 525,000. And for Y, we are taking, this should be 40 and not 50. X is 40 times 15,000. 40 shillings times 15,000, which is 600,000. And then Y is 35 multiplied by 18,000, which will give us 630,000. Then we move on to direct labor. Direct labor. So for direct labor, W is 30. We take 30 shillings. We multiply by 10,000, which will give us 300,000. For X, we have 35 multiplied by 15,000. This is 525,000. For Y, we have 30 multiplied by 18,000. And this is 540,000. Then we get the prime cost. Show the prime cost. This will be 800,000. Then we get the totals for X. 1,125,000. Then for Y, 1,170,000. From there, we now calculate the production overheads or cost. So according to the question, we are using ABC. I can use production overheads. So the production overheads that we have are based on the number of requisitions. Number of requisitions. I'll just write requisitions. It's based on requisitions. And number of setups. So we are beginning with the requisitions. For W, the requisitions were 1,200. And the cost per requisition is 280. So to get the amount for product W, we are simply getting the cost per unit or per requisition times the number of requisitions, which was 1,200. And this will give us 336,000. Do the same for Y. Cost per requisition, 280 times number of requisitions, which is 1,800. This is 504,000. For Y, 280 multiplied by 2,000 requisitions. This is 560,000. Then we have setups. So the cost per setup was 1500, and for W we had 240 setups. So you take 1500 times 240, which will give us 360,000. For X, 1500 times 260, which is 390,000. And then the last one, X, is 1500 times 300, which is 450,000. From there, we now get the total cost. We get the total cost. This is 1,496,000. This is 2,019,000. 2,180,000. The question required us to calculate the profit per unit of each of the three products. So once we have this, we are to show the profit and then the selling price. So we are to determine the profit, but we have not been given either the margin or the markup, though we have the selling price. So remember, profit is simply selling price minus total cost. And so we are calculating the total, the selling price. Once we get the selling price, we will use that to get the profit. We were given the selling price, we know the number of units that were produced. So for W, the selling price was 200 shillings per unit, and the number of units produced was 10,000. So this will give us 2 million. And for X, the selling price is 183 times 15,000, which is 2,745,000. For Y, selling price is 175 times 18,000, and this will be 3,150,000. So from there we can calculate the profit. Profit is now the selling price minus the total cost. So we have 2 million minus 1,496,000, which will give us 504,000. Then for W, we have 2,745,000 minus 2,019,000, which gives 726,000. And then Y, 970,000. And that is how this question was to be calculated. So thank you, bye-bye. Let's meet in the next session.
Welcome, candidates. Today we are going to answer question 2. The subject, Advanced Financial Management, November 2020. Question 2. In our last session, we answered question 1. Question 2A, I read, the following information relates to 2 mutual funds operating in your country. Omega Mutual Fund and Beta Mutual Fund. The realized return, 13% Omega Mutual Fund, 18% Beta Mutual Fund. Beta, 1 for Omega Mutual Fund, 2 Beta Mutual Fund. Standard deviation, 19% Omega Mutual Fund, 15% Beta Mutual Fund. Additional information, number 1, the return on the market index is 12%. Number 2, the risk-free rate is 8%. Required for each of the above mutual funds, compute the following performance index scores. Roman 1, Jason's Alpha, 2 marks. Roman 2, Trenos Alpha, 2 marks. Roman 3, Sharp Index for the funds and the market, 3 marks. This is question 2A. You have to compute for each mutual fund, Jensen alpha, Trenos alpha, and Sharp index. Roman 1. So candidates, as usual, it's important to put down the formula. The formula for Jensen's alpha. The first one, Jensen's alpha. The formula is R, the return of portfolio, minus R risk-free, this is risk-free, plus beta RM minus RF minus RF. Jensen's alpha. Now, candidates, Jensen's alpha was developed by Michael Jensen. That's where we get the word Jensen. Jensen is a person whose other name is Michael. It was developed in 1968, and the purpose was to measure the difference between a portfolio's actual return and its expected return according to the KPM. So that's the formula. So let's work out the Jensen's alpha for the first company here is Omega. Omega's return on portfolio is realized return is 13%. 13% minus Omega's, this is Omega's risk-free, and that the risk-free is just the treasury bill is 8%. That is 8% plus beta omega beta is just 1. Substituting the values in the formula, candidates. 1 into the market return. The market return is 12% minus 8%. That will give us the Jensen's alpha for Omega fund. Then we do the same for the next fund, which is beta. The risk-free, the return on beta mutual fund return is 18%. 18% minus risk-free remains 8% plus beta 2 times the market return 12% minus the risk-free 8%. That will give us the Jensen's alpha for Omega and beta. These are fund, beta fund. Then the next candidate is Trenos alpha. Trenos alpha candidates. The formula is the portfolio return minus risk-free rate divide the portfolio beta. Going to the question, the return omega realized return is 13%. 13% minus risk-free 8% divided by beta of 1. How about beta fund? Beta fund return is 18%. 18% minus risk-free 8% divided by 2. Then I'm going to calculate the other measure, which is sharp index. Sharp index. We know the formula, candidates, is equal to the portfolio return minus the risk-free divided by the standard deviation of the portfolio. For the return on omega fund is 13% minus risk-free 8% divided by standard deviation. The standard deviation omega 19%. Next we have, that will give us the answer here. Then we have sharpest for omega beta fund. Beta fund, the return 18% minus 8% divided by the standard deviation 15%. 15%. Then lastly, candidates, is the market. Sharpest index for the funds and the market. The sharpest index for the market, sharp index for the market, will have, this will be equal to, sharpest index for the market is just the market return. The market return will be equal to the market return, the market minus the risk-free. Then we divide the market standard deviation for the market. So candidates, is important you have the formula in your head so that you can retrieve it anytime. So when faced with such a question, first of all, you put down the formula, then you check the inputs from the question and insert in the formula. Then the rest is the work of the machine. The machine will do the rest of the work. For example, here we want to calculate the Jensen's alpha for omega fund. That will be equal to one. Beta fund, this is equal to 2. Trenos alpha is 5. This is 18 minus 8, 10 divided by 2, 5. Then sharp for omega fund, sharp index omega fund, 0.263. Then here we have it's equal to 0.666. For sharp index candidates, we have the market return. Sharp index for the market, we'll have the market return. The market return is 12% minus risk-free of 8% divided by the standard deviation for the market. Now, candidates, the question did not provide the standard deviation for the market, and that seems to be an error of omission. So we are going to assume a standard deviation of 25% for the market. Okay, 25% for the market. 25% for the market, that is 12 minus 8 divide 25. This is 0.16. So we have assumed a standard deviation for the market is 25%. This is not provided in the question yet, candidates. For you to calculate the Sharpe index for the market, you require the market return, you require the risk-free rate and the standard deviation for the market. So candidates, that is part A. Part A, how many marks are this? Part A, we have Jensen's alpha, 2 marks, 1 mark, 1 mark. Trenor's alpha, 1 mark, 1 mark. Then Sharpe, 3 marks, 1 mark, 1 mark total. These are 7 marks. 7 marks. 7 marks. 7 easy marks. 7 easy marks. The marks are easy if you have the formula. And you can see if student who had the formula, then it becomes easy to calculate these measures. Jensen measure, I said earlier, is a measure that we get after, is a measure to calculate the difference. It's a measure to calculate the difference between the portfolio actual return and its expected return according to CAPM. Now, Trenor's alpha, on the other hand, provides a measure of performance adjusted for market risk. That means it shows the return earned over the risk-free return per unit of market risk. And candidates, the higher the Trenor's ratio, the better the performance of the fund. And you can see these funds have equal performance. They are performing equally because both have a ratio of 5:5. Now, candidates, the Sharpe's index measures how much a fund has returned for each unit of risk taken. Sharpe's index measures how much a fund has returned for each unit of risk that is taken. Now we are going to answer part B, which says the estimated factor sensitivities of Diamond Limited to farmer fringe factors and the Pastor-Stamber model factors and the risk premium associated with those factors are given in the table below. There is a table, there is a column on factor sensitivity and risk premium in percentage. The first one is a market factor, then there is a size factor, the value factor, liquidity factor, and the treasury bills rate is 5%. Required, Roman 1, the required rate using the farmer fringe model, 3 marks. Roman 2, the required rate of return using the Pastor-Stamber model, 3 marks. 3 marks. This is part B. Farmer fringe return. We need to calculate farmer fringe, the required rate of return using the farmer fringe model. Now, candidates, this farmer fringe model is a work of Eugene Farmer and Kenneth French. Eugene Farmer and Kenneth French, that this model addresses the perceived weaknesses of the CAPM. And there are three main factors in the French model. And these factors are abbreviated as RM, RF, RM, RF. RM, let me just do some small introduction to this model. RM, RM, RF. This is the first factor. The next factor is the SMB, SMB factor. Then there is a HML, HML factor. There are three factors. Okay? This researcher, they were researchers, these two researchers, in not quite long ago, in about 1990 or 1993, thereabout, the Eugene Farmer and Kenneth French addressed the perceived weaknesses of the CAPM model with three factors, which are known as the Farmer-French model. RMRF is one of the factors, and RM stands for the return on market. RF stands for risk-free. Okay? The risk-free, or the 3 months treasury bill. The is a 3 month treasury bill, and is one of the equity risk premium that can be presented, and is a factor that is shared with the CAPM. Okay, the premium, we know candidates in CAPM, we know that premium is equal to the return on the market minus the risk-free rate. This is what it means, RM, RF. That's the first factor. Then SMB candidates, small minus big, or a size, or what we call market capitalization factor. It is the average return on 3 small cap portfolios minus the average return on 3 large cap portfolios. So the SMB represents a small cap return premium, a small cap return premium. How about the HML? The HML candidates is a high minus low. That is the average return on 2 high book to market portfolios minus the average return on 2 low book to market portfolios. All right. Now, if you are to put this in a formula, candidates, the Farmer-French return, can be calculated as follows. The Farmer-French return will be equal to the risk-free rate plus sensitivity plus sensitivity to equity market factor times the equity risk premium, plus plus sensitivity to size factor times the size risk premium, plus candidates sensitivity to value times value risk premium. That's the formula to calculate the return based on the Farmer-French model. You can see we have risk-free plus, these are 5 things. 1, 2, 3, 4. There are 4. 1, 2, 3, 4. 4 inputs. Number 1 is the risk-free rate. Then there is sensitivity to equity market factor. Equity market factor times equity risk premium. Equity. That's how you relate these things, candidates. Then there is plus sensitivity to size factor. Size. The premium here is the size risk premium plus sensitivity to value factor. We have value times value risk factor. Value. So we have equity, size, value. So let us now get these inputs from the question. Get the inputs from the question. First of all, we have the risk-free rate. 5%. That is the treasury bill rate, is the risk-free rate. We add sensitivity to equity market factor. Sensitivity to equity market factor is 1.05 times its premium, 1.05. The premium is on the right hand side of the third column of 5% plus the sensitivity to size. Size is the next factor. Sensitivity to size factor, that is negative 0.65 times the factor, size factor 2.5 plus the sensitivity to value. The next one is value negative 0.2 times the value premium 4.5. That will give us the return based on the Farmer-French model. Next step is to use the machine. That is equal to 7.725. 7.725. That is the return. 7.72%. 7.725%. Now, candidates, you can see there are 3 main steps here when calculating this kind of a question, when finding the return based on the Farmer-French model. The first step, put down the formula. That's the formula. Put down the formula. Then the next step is to insert the inputs from the question. Okay? From the question, we substituted these values from the figures in the question. So that's step number 1, then step number 2. The third step is to use the machine. You are allowed to use a calculator in your exam. Use a machine and then just get the marks. These are how many marks? 3 marks. These are 3 marks. 3 marks. 3 marks. It's a mark for that step. Formula, it's a mark for the formula. Then there's a mark for identifying the right inputs, then calculation. We are now going to answer the second part of B. We've done the farmer French, the required rate of return using the farmer French. In part B, we are going to calculate the required rate of return using the Pastor-Stumble model. Pastor-Stumble model, Roman 2. Now, what is this model all about? Candidates, the Pastor and Stumble, these are again two persons, researchers. Pastor and Stumble, which is a more recent model. The other one, this French model, I said it was about 1993. This one is about the year 2003. In the year 2003, Pastor and Stumble extended the farmer French model to encompass compensation for the degree of liquidity of equity investment. And this model is mostly applied to the public security investment as well as certain private security investments. So the Pastor-Stumble model adds to the farmer French model a fourth factor. These are three main factors. This is the market factor. We have the size factor. Then there is the value factor. This model adds the fourth factor, which is the liquidity factor. That's why in this question, the fourth factor there is the liquidity factor. So the model is just the same, apart from the fact that the Pastor-Stumble model adds the fourth factor, which is the liquidity factor. So the return based on the Pastor-Stumble model will be equal to risk-free. Let me use my blue pen, or let me just use my black pen. The risk-free will be equal to the risk-free rate plus sensitivity to equity market times equity risk premium, plus sensitivity to size factor times size risk factor plus this is 1, 2, plus the third one is the sensitivity to value factor times value risk factor plus the fourth factor, which is in this table here, the liquidity factor, sensitivity to liquidity factor times the liquidity risk factor, That will give us the return based on the Pastor-Stumble model. So we have the return is equal to the risk-free rate plus sensitivity to equity market times equity risk premium plus sensitivity to size factor times size risk factor plus sensitivity value factor times value risk factor plus sensitivity to liquidity factor times liquidity risk factor times liquidity risk factor. That is the formula. You can see here we have equity market factor, then we have equity risk premium. Then here we have size factor. We multiply by the size risk factor. The other factor is the value factor. We multiply with the value risk factor plus sensitivity liquidity factor times the liquidity risk factor. Liquidity risk factor. So we are going to go to the next step, which is to insert the values. And candidates, we saw the first four values. We have just said that the Pastor-Stamble model introduces the liquidity factor to the Farmer-French model, the FFM model. This is the FFM model. This model introduces an additional factor, the liquidity factor. So in part 1, we had determined the Farmer-French factor, and the Farmer-French factor we've seen is 7.725%. That's the return. So we are introducing another addition to this, which is an improvement, okay? Is an extension. The extension, this is the Farmer-French model. An extension is the liquidity factor. So we read from the question, the liquidity factor is 0.2 times the liquidity risk factor. The liquidity risk factor is 4.5. 4.5. This 0.2 positive. So that will give us the answer. This is 7.725 plus 0.2 times 4.5. I'm getting here 8.625%. So that is the Pastor and Stamble return, the return based on the Pastor and Stamble model. Is that clear, candidates? That should be clear because I've explained the two models. I've shown you how to derive how to come up with the formula. I've shown you how to insert the values, and then the rest is the work of the calculator. So candidates, this again 3 marks. There is a mark for the formula. There is a mark for inserting the right values, then calculation. 3 marks. 3 marks. 3 marks. We are now going to answer part C, which reads, part C reads, you have recently been hired as a financial manager at Pamblock Limited, a locally incorporated company that deals in important building materials from the United States of America. As the person in charge of negotiating the exchange rates, you have noted the following indicative exchange rates and interest rates. 3 months forward exchange rate, there is a spot exchange rate of 100 Kenya shillings per US dollar. 3 months interest rate in Kenya is 8% per annum. 3 months interest rate in US is 5.8% per annum. The 3 months forward exchange rate is 100 shillings per US dollar. Assume that Pamblock Limited can borrow as much as 1 million Kenya shillings required. Determine Roman 1 whether the interest rate parity is currently holding, 2 marks. Roman 2, demonstrate how you could undertake a covered interest arbitrage assuming that the IRP is not holding, 4 marks. Roman 3, determine the arbitrage profit, 1 mark. That is part C of question number 2, November 2020, Advanced Financial Management. Part C, Roman 1. Demonstrate that the interest rate parity is currently holding. Candidates, what is this thing known as interest rate parity? Now, candidates, when the market forces cause interest rates and exchange rates to adjust such that the covered interest arbitrage is no longer feasible, the result is what we call an equilibrium state that is known as the interest rate parity. And if the interest rate parity exists, then the rate of return that is achieved from the covered interest arbitrage should be equal to the interest rate of the home country. Should be equal to what? The interest rate of the home country. The return should be equal to the interest rate of the home country. That's a very important statement to enable us answer this part. It says, determine whether the interest rate parity is currently holding. At what point does the interest rate parity hold? The answer is, candidates, it holds when the return from the covered interest rate arbitrage is equal to the interest of the home country. And for those who didn't attend the class lessons, I know some of you just joined the block revision sessions. For those of you who may not have covered the area, arbitrage can loosely be defined as capitalizing on a discrepancy in the quoted prices by making a riskless profit. And the covered interest arbitrage is a process of capitalizing on the differences in interest rates between two countries while covering your exchange rate risk with a forward contract. And the logic, candidates, of the term covered interest arbitrage becomes clear when it is broken down into, say, arbitrage. Interest arbitrage, okay? Interest arbitrage. So what is interest arbitrage? Interest arbitrage refers to the process of capitalizing on the differences between interest rates between countries. And covered means hedging your position against exchange rate risk. So covered interest arbitrage is sometimes interpreted to mean that the funds to be invested are borrowed locally. And in that case, the investors are not tying up any of their own funds. And it is a strategy, candidates, whereby an investor capitalizes on the interest rate differentials between countries by using a forward contract to cover exchange risks. there's an important definition for those who had not covered the syllabus, candidates. I'm defining covered interest rate arbitrage. I'm saying is the process of using favorable interest rate differentials to invest in a higher yielding currency and hedging the exchange risk through a forward currency contract. In this question, we've been provided with the 3 months forward exchange rate, and we see here is the exchange rate is 105 Kenya shillings per dollar per US dollar. Then the spot exchange rate is 100 Kenya shillings per US dollar. The 3 months interest rate in Kenya is 8% per annum. The 3 months interest rate in the USA is 5.5% per annum. Assume that Pan Block Limited can borrow as much as 1 million Kenya shillings. Required, determine whether the interest rate parity is currently holding. And I've said the interest rate is holding where the return is equal to the return from arbitrage is equal to the interest rate of the home country. But candidates, another important point to note is we need to calculate the return as a result of arbitrage, and that return should be equal to the interest of the home country, which we also need to calculate because the interest of the home country has not been provided. The interest of the home country has not been provided in this question. So we are going to first of all calculate the interest on the home country. We are going to calculate the interest of the home country, and we've seen, candidates, the interest there is 3 months interest rate is 8% per annum. Therefore, the interest in the home country is going to be 8% times 3/12. We're going to apportion it. We apportion this to get the interest of the home country because the 8% is per annum. So what will be the interest for the 3 months? So that's going to be 24 divide 1200. The interest here is 0.02, which is equal to 2%. And now you calculate this one for home country. We will then calculate the interest for the foreign country, USA. And the USA interest is going to be 5.8%. This is 5.8% times 3/12. That will be equal to, this is equal to 0.0145, which is equivalent to 1.45%. These are important interest rates that will help us answer the question. We want to demonstrate if the IRP is currently holding. And I've said the formula is, we need to calculate the return. Firstly, I've said that the interest rate exists when the rate of return is equal to the interest rate in the home country. So we've calculated the interest rate in the home country, that is 2%. So we are going to calculate the interest, the return as a result of the arbitrage process. What is the return? The return, candidates, is calculated as follows. R is equal to 1 plus interest in the foreign country, 1 plus premium minus 1. Okay, this formula is going to give us the rate of return on investment. There are two important inputs. The interest rate in the foreign country, which you have calculated here. Then we have the premium. The premium. We need to calculate the premium, candidates. I'm going to have a working. Going to have working for the premium. Candidates, we know that the premium is equal to premium or discount is equal to 1 plus interest in the home country over 1 plus interest in foreign country minus 1. The interest home country we calculated here is 0.02 over interest in the foreign country 1.45%, converted into decimal 0.0145 minus 1. That will give us the premium, and that will be equal to 1.02 divide 1.0145 minus 1. The premium is equal to 0.00542. That is the premium. So candidates, coming here, we will substitute. We have 1 plus interest foreign country, the USA, 0.0145 times 1 plus the premium, 0.00542 minus 1. So candidates, the rate of return on investment is 1.0145 times 1.00542 minus 1. This gives me 0.02. Candidates, you can see that the rate of return on investment, when converted into percentage, this is 2%. You can see, candidates, the rate of return here, this rate of return is equal to the interest in the home country of 2%. 2%. Therefore, the IRP is currently holding, because initially we sought to find out if the IRP is currently holding. That is the question. Determine whether the interest rate parity is currently holding. And I say that if IRP exists, then the rate of return that is achieved from the covered interest arbitrage should be equal to the interest available in the home country. So you see, the interest available in the home country is equal to the rate of return. That is the answer. How many marks? 2 marks. 2 marks. 1, 2. 2 marks. Then moving on to part 3, demonstrate how you could undertake a covered interest arbitrage assuming that IRP is not holding. In part 2, we are going to demonstrate how one can undertake a covered interest arbitrage assuming that IRP is not holding. Now, candidates, assuming that IRP is not holding, first of all, Roman 2, first of all, it should be noted that this company, Panblock Limited, can borrow 1 million Kenya shillings, can borrow 1 million Kenya shillings today. So, to demonstrate how one could undertake a covered interest arbitrage assuming that IRP is not holding, step number 1 is to convert the 1 million Kenya shillings. First of all is to borrow. Let me start there. Borrow Kenya shillings 1 million. 1 million Kenya shillings. Candidates, the interest rate in Kenya is 2%. So this money will be repaid. Repayment after 3 months will be 1 million times the factor 1.02, which is equal to 1020. So this money that was borrowed will be repaid with an interest of 20,000. Now, the next step, candidates, is to use the 1 million that is borrowed, candidates, and convert the 1 million to US dollars. Convert 1 million Kenya shillings that is borrowed now to US dollars using the spot exchange rate. Using the spot exchange rate of 100 shillings per dollar. 100 shillings per dollar, and this will be equal to 10,000 US dollars. 10,000 US dollars. The next step, candidates, is to invest the 10,000 US dollars. Invest the 10,000 US dollars in the US. Using the foreign exchange rate of 1.45% at 1.45%. 1.45%. And that will be equal to, this will be equal to dollars 10,145. And this I got it, candidates, by multiplying $10,000 times 1.0145. So invest the $10,000 in the US to earn an interest of 1.45 after 3 months. Then we'll then convert this amount, convert the 10,000 US dollars, 10,145 US dollars to Kenya shillings using the forward exchange exchange rate of shillings 105. 105. This is 105 shillings per dollar. 105 shillings per dollar. Therefore, the amount to be received, the receipt at the end of the third month will be equal to $10,145 times 105 Kenya shillings. These are dollars, these are shillings. This will be equal to 10,145, 10,145 times 105. 105, I'm getting here shillings 1,665,225. This is the receipt the company will have after a period of 3 months. So we have demonstrated how you could undertake a covered interest arbitrage, assuming that the IRP is not holding. IRP is not holding. That is part 2. Then part 3, candidates were to calculate the arbitrage process, arbitrage profit, arbitrage, the arbitrage profit will be equal to this receipt minus the repayment we calculated at start here. The repayment, this is the repayment. This is the amount that this company was expected to pay were it not to invest in the US. If the company did not invest in the US, the company was to pay 1,020,000 shillings. But the company decided to borrow, then the company bought dollars, then invested the dollars in the US at an interest rate of 1.45%. Then the amount, the dollars that were received at the end of the third month were converted back into Kenya shillings to earn a receipt of 1,065,000 shillings 225. So the difference will be the arbitrage profit, the difference of 1065 225 minus 1020. The arbitrage profit here is the arbitrage profit 45,225. 225. The arbitrage profit is just a mark. This is 1 mark. 1 mark. The demonstration on how you could undertake covered interest arbitrage assuming that IRP is not holding is 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. 4 marks. So candidates, that is the solution to question number 2 that was tested in November 2020. Thank you for attending our today's session. I urge you to continue revising. Before you attend our next session, please try and answer question number 3, which is in 2 parts, part A and part B. Part A, I see students who are to explain certain terms there, like the primary mortgage market and secondary mortgage market, 2 marks. Roman 2, fixed rate mortgage and adjustable rate mortgage. 3, the lien and the recourse. Then part B, I see a question where students were required to calculate the expected return, correlation, coefficient, and standard deviation. Candidates were also to calculate the mean variance of a project. So please try and answer question 3 before coming in to the next lesson where we are going to answer The next question, November 2020, question number 3. Thank you. God bless you. Bye-bye.
Part B of the question reads as follows. S and M are advocates operating under the name SM Advocates. The firm's trial balance for the year ended 30th June 2022 is as shown below. They are talking of costs charged to clients through to capital. Of course, the trial balance has been given and it is balancing at 1,518,000 and also 1,518,000. Additional information. It's estimated that debts amounting to 16,500 are uncollectible and should be written off. Depreciation, that is number 2, depreciation should be provided at the rate of 20% per annum on the book value of the furniture, fittings and library books. The uncompleted work on 30th June 2022 was valued at 70,500,000. Required statement of profit or loss for the year ended 30th June 2022 and the statement of financial position as of 30th June 2022. So this question was under preparation of financial statements from other entities, and more specifically it's about professional firms, and this is a firm for advocates. So we'll go straight to the first part of the required, that is Roman 1. SM Advocates. SM Advocates. Statement of profit or loss. Statement of profit or loss. Statement of profit or loss for the year ended. For the year ended 30th June. For the year ended 30th June 2022. Great. So shillings. Cost charged to clients. Cost charged to clients, that is the same as professional fees. So we are going to use as it is. Costs charged to clients. Costs charged to clients. Same as professional fees. 750,000. 750,000. Add work in progress. Work in progress. Work in progress carried down. A work in progress carried down is the same as additional information number 3. And completed work, that is 7,500. 7,500 less work in progress brought down. Work in progress brought down is the same as the work in progress balance brought down on the trial balance, 110,400. So this one is going to be deducted. So that is 750,000 plus 7,500 minus 110,400, 710,100, 710,100. That is like total income. total professional fees for that period, less expenses, less expenses. The first expense is office expenses. Office expenses. The office expenses amounted to 25,500. 25,500. Postage, telephone and internet. Postage, telephone and internet. So postage, telephone and internet amounted to 54,600. 54,600. Printing and stationery. Printing and stationery amounted to 105,000. Printing and stationery. Rent and rates. Rent and rates 180,000. That has been given us 180,000. Salaries to staff. Salaries to staff 216,000. Salaries to staff is 216,000. And finally, the expenses on the trial balance have been exhausted. We move to the additional information number 1. There is irrecoverable debts. Irrecoverable debts. Irrecoverable debts amounted to 16,500. And finally, depreciation, which is being provided on furniture and fittings, and depreciation is at the rate of 20% per annum on book value. 20% per annum on book value. So we have the figure of furniture, which is of course at book value. So that is 20% times the value of furniture is 135,000. 135,000. That will give us 135,000 times 20%, 27,000. 27,000. Once you have the expenses there, it is 25,500 plus 54,600 plus 105,000 plus 180,000 plus 216,000 plus 16,500 plus 27,000. This is 624,600. 624,600. And profit for the year. Profit for the year. The profit for the year is 710,100 minus the answer 85,500. 85,500. So that was the statement of profit or loss for that professional firm during that particular period. That takes us to the statement of financial position. SM Advocates. SM Advocates. Statement of financial position. Financial position as at 30th June. 30th June 2022. As at 30th June 2022. So we have assets, or before assets we can bring in the two columns. and non-current assets. Under non-current assets, we have furniture, fittings, and library books. Furniture, fittings, and library books. Furniture, fitting, and library books. Now let us compute the book value for the same. The cost is 135,000. Remember, the cost was 135,000 minus depreciation, which we've computed as 27 minus 27,000. That's the depreciation that we even computed in the statement of profit or loss. The book value is 108,000. 108,000, and that is the only non-current assets. Current assets. Current assets. We have the first one being work in progress, carried down, work in progress at the end of the year. The work in progress at the end of the year, in additional information number 3, was 7,500. We have receivables. Receivables amounted to 234,000. 234,000. Cash at bank. Cash at bank. Or before we record cash at bank, receivables is to be affected because there was irrecoverable debts. There was some irrecoverable debts, so this one is going to be reduced. So that is 234,000 minus the recoverable debts of 16,500. 16,500. So that is 234,000 minus 16,500, 217,500. 217,500. Then there is cash at bank divided into 2. There is client and there is office account. Client account and office account. Client account is 74,400. Office account is 167,100. 167,100. Any other current asset here? We have disbursement on behalf of clients. 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 36,000. 36,000. Disbursement on behalf of clients. 36,000. So the total assets. Total current assets 7,500 plus 217,500 plus 74,400 plus 167,100 plus 36,000 565,500 565,500 565,500. Total assets. Total assets plus 108,000 673,500 673,500. From that point we move to capital and liabilities. Capital and liabilities, and we have capital. The capital account stood at a balance of 612,000. Add profit for the year. The profit for the year was 85,500 less drawings. Drawings amounted to 180,000. Drawings amounted to 180,000 and they are to be subtracted. So that is 612,000 plus 85,500 minus 180,000, 517,500. Non-current liabilities. Non-current liabilities, and non-current liabilities were not there, so it's going to be nil. Current liabilities. Current liabilities were given as follows. We have clients for monies held on their behalf. So clients for monies, clients for monies held, of course, on their behalf, for monies held on their behalf, amounted to 74,400. 74,400. Creditors, 81,600. Creditors, 81,600. Total is 74,400 plus 81,600, 156,000, which gives us the total capital and liabilities. Total capital and liabilities, which is 517,500 plus 156,000, you get 673,500. 673,500. 673,500. So, learners, that is how the question was supposed to be handled. That is for financial reporting August 2022 question 4, which combined lease accounting IFRS 16 and also professional firms in financial statement of other entities, and more specifically professional firms. See you again in our other subsequent revisions. My name is Nicholas Sikali.
Welcome to Manifested Publishers. We offer KASNEB study materials and video lectures.
Candidates, here I am again to continue revising the paper that was tested in May 2019, that is Advanced Financial Management. Having done question 1, 2, 3, and 4, in our today's lesson we are going to tackle question number 5. And this question 5 is in two parts, part A and part B. Part A is a question that tests a candidate's knowledge in capital budgeting decision. Part B is a question from the topic mergers and acquisitions. I will read question 5A first, then I'll answer it here on the board. And as we answer these questions, candidates, I need to remind you that the objective of the Advanced Financial Management paper is to enable you that at the end of these sessions, you should be able to apply advanced financial management techniques in business. That is why you can see some of these questions are practical questions. These are problems that businesses face which call for techniques in advanced financial management. And as an accountant who is training, should not also be lost on you that the purpose of studying advanced financial management is more than just passing the paper. As you study this paper, make sure you are gaining the skills, the knowledge, and the expertise that is required of you to solve problems that organizations face. Now, question 5A is a problem that requires the knowledge in capital budgeting, techniques in capital budgeting. So let me read the question. It says that Jeza Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 shillings each. Installation costs for all the computers will amount to 80,000 shillings. It is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million shillings to 12,500,000 shillings annually. The computers are expected to last for 10 years, after which they will be obsolete with no resale value. The operations manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. The probability distribution of the useful life of the computers is given as follows. The probability that the computers will be useful for 5 years is 0.2. Probability the computers will be useful for 10 years is 0.5. Probability that the computers will be useful in 15 years is 0.3. The company is in the 30% tax bracket. The company's cost of capital is 24% and uses the straight line method of depreciation. Required, Roman 1, the expected net present value of the project, 4 marks. Roman 2, the standard deviation of the expected net present value, 3 marks. Roman 3, if the net present value of the project is less than 200,000 shillings, the firm will be exposed to financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution, 3 marks. Candidates, here is a problem, okay, that we need to solve. This is a past paper question that was tested in May 2019. The candidates who appeared in that exam were expected to answer this question so as to earn how many marks? These are 10 marks. 10 marks. So candidates, this again I repeat is a problem, and just like any other problem, this problem requires a formula. Every problem has a formula which has to be applied in solving it. So this is a problem that we need to solve, and the past paper question, this is May 2019. This is advanced financial management, question number 5. All right, May 2019, the advanced financial management paper. Part A, we are required to calculate the expected net present value. Okay, we are required to calculate the expected net present value. Expected net present value. Expected. We've been given the cash flows, all right, because we know for you to calculate the NPV of a project, then it's the difference between the NPV or the present value of cash inflows minus the present value of cash outflows. That is the general formula for calculation of NPV. So this is question 5A, Roman 1, expected NPV. Here is the formula. Expected NPV is equal to the NPV of the first alternative. And the first alternative is where the economic life of the computers is 5 years. So the NPV of the first alternative 5 years times probability of the 5 years, okay, probability of alternative where the machine is, the machines will last in the business for 5 years, plus NPV of the second alternative. And the second alternative is where the machines have an economic life of 10 years times probability of the machine lasting in the business for 10 years, that is 10, plus NPV of the third option where the economic life of the computers is expected to be 15 years times probability that the computers will last in the business for 15 years. So this will be the expected NPV formula. So candidates, when in an exam, you need to be writing down the formula first, because it's on the basis of this formula that you are going to answer this question. Because even if you are not to answer the whole question, this one can earn you a mark. This part A, you can see there are 4 marks, right? Writing a formula can earn you 4 marks. So, I mean, can earn you a mark. So, candidates, we need to calculate the NPV where the economic life of the computers is 5 years. Then we multiply by probability as shown in the table there. It shows the probability distribution of the useful life of computers is given as follows. Useful life of 5 years, the probability is 0.2, and the other one 0.5, then 0.3. So we'll get the NPV where the economic life is 5 years times that probability. Then we add to the probability, we add to the NPV where the economic life is 10 years and probability for that option. Then we'll add the NPV where the economic useful life is 15 years times the probability of that alternative. So that is what we are going to do. Now, NPV for the first alternative. How do you calculate NPV for the first alternative? NPV for the first alternative will be the difference between the cash inflows minus cash outflows. So we are going to calculate the cash inflows minus the cash outflows. And from this question, we can read that it is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. So these cash flows, because it's annually, that will tell you that these are annuities. It's very important. These are annuities. So these are incremental annuities. These are inflows. So we are going to deduct these inflows for every alternative by, we are going to subtract with the initial cash outlay, the initial cash outlay for every the initial cash outlay is standard. You can see here that we are told in the second sentence that in order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 shillings each. So this will comprise part of the initial cost. Then down there we have installation cost for all the computers will amount to 80,000 shillings. So the initial cost plus installation cost, that will be the total initial cash outlay. So let's first work out the initial cash outlay. I'm going to have my workings here. These are my workings. Show all workings. Working number 1 will be the total initial cash outlay, and this will be equal to the cost. The cost that will be equal to the cost, that is the purchase cost, which is 1,000 shillings times 8 microcomputers. So this will be equal to the cost of computers plus installation cost. The cost of the 8 computers will be 8 computers times 100,000 shillings plus the installation of the 8 computers we were told in the question is 80,000. So we have 800,000 plus 80,000, which is equal to 880,000. That is the initial cash outlay that we'll use when computing the NPV for each option. That is working number 1. Now, working number 1. Now, working number 2, we need to calculate the NPV for each alternative. NPV for each alternative. There are 3 alternatives. That is 1, where the economic life of the computers is expected to be 5 years. The second alternative is where the economic life of the computers is expected to be 10 years. Then 3, where the economic life of the computers is expected to be 15 years. So the NPV, where the economic life of the computers is 5 years, what is the NPV? The NPV will be equal to the cash inflows, will be equal to the present value of cash inflows minus the present value of cash outflows. That is the formula for NPV. So, formula for NPV. We have seen the cash outflow, the initial cash outlay, which is 880,000. So what is the present value of the cash inflows? And we have said that this cash inflow, remember I said, is an annuity. These are annuities. So we are going to calculate the annuities, the annual cash inflow, annual cash inflows, then we multiply with the present value annuity factor at 5 years, and the discounting rate will be, the last sentence there, the company's cost of capital is 24% and uses the straight line method of depreciation. So candidates, these inflows, as we have read from the question, these are annuities. These are annuities. For us to compute the NPV for each alternative, then we need to have the annuities, the annual cash flows for each alternative. And let me have a formula let me have a working for the annual incremental net cash inflows. I'm going to have a working, okay, a working for the net cash inflows. Net cash inflows. We need the net cash inflows for each option. So the net cash inflows will be equal to, this will be equal to, this is, let me just write in full for your revision, annual, let me call it annual incremental net operating cash inflows. This will be equal to this is net, let me abbreviate it, net operating cash inflows. This is equal to, this is an abbreviation of that, incremental net operating cash inflows will be equal to the earnings before depreciation and tax, earnings before depreciation and tax times 1 minus T plus DTS, depreciation tax shield, DTS, depreciation tax shield. So we want to compute the annual incremental net operating cash flows for the three options. The first option, the last option, I want to start with the last one here, is when the economic life is equal to 15 years, when the economic life N is equal to 10 years, and when the economic life N is equal to 5 years. So I want to have a working, just one working for these three options. So what is the EBT, EBDT, earnings before depreciation and tax? It's an annuity, and that is in note number, the second paragraph. It says that it is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. That's an annuity. Earnings before depreciation and tax. This is the incremental. We are working with incremental. Incremental earnings before depreciation and tax will be the difference between 12.5 million and 12 million, which is 500,000. 500,000. That is earnings before depreciation and tax. Then we deduct the tax. This is tax of 30%. So 30% times 500, this is equal to 150, 150, 150, 150, 150, 150, 150, giving us here 350, 350, 350. So these are earnings after tax, okay? Earnings after tax. You have deducted the tax. This is earnings after tax, or we can say this is EBDT 1 minus T. Okay, 1 minus T. 1 minus T. We've multiplied this by that tax, so this is minus the tax. this minus the tax, this minus the tax. Then we are going to add the depreciation tax shield. You see here we have ABDT 1 minus T, EBDT 1 minus T plus depreciation tax shield. We are going to calculate depreciation tax shield for each option. Depreciation tax shield for each option, depreciation. Now let's go check the information for depreciation. Now it says the computers are expected to last for 10 years, after which they will be obsolete with no resale value. Then the operations manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. 50,000 shillings each. Then the depreciation policy, the last sentence, the company's cost of capital is 24% and uses the straight line method of depreciation. So the depreciation tax shield candidates will be equal to the depreciation per annum times the tax rate, So we are going to have depreciation here will be the DTS. The DTS will be equal to 30%. That is depreciation, that is the tax, times depreciation. And since this company is using the straight line method, that will be equal to the cost minus the scrap value or salvage value divided by the economic life. This is the formula for the DTS. The DTS will add to the after-tax earnings. Depreciation tax shield for the first option. The DTS for the first option, let me do it here. The DTS for the first option, where the economic life is 5 years, will be equal to 30% times the annual depreciation. The cost remains 880 minus the salvage value. We read that the salvage value will be 50, after which they can be disposed of at 50,000 shillings each. 50,000 shillings each. Each computer will be disposed of at 50,000 shillings each, meaning the salvage value of the 8 computers will be 50,000 times 8. 50,000 times 8, then we divide by 5 years. So this will give us the DTS, which is equal to this is 880 minus this is 400 minus 400 divided by 5 times 30%. I'm getting 28.8. For the depreciation tax shield, 28.8. That is for the first option. The second option, the DTS, where the economic life is expected to be 10 years, equal to 30% times 880,000 minus 0. We read the economic life is 0, then divide by 10 years. 10 years. So I'll have 880 divided by 10 times 30%. Getting a 26.4. 26.4. 26.4. Then lastly, DTS, where the economic life is 15 years, is equal to 30% times 880 minus 880,000 minus 0. The salvage value under this option is 0. Divide by 15. Divide by 15. So I'll take 880 divide 15 times 30%. This is equal to 17.6. 17.6. 17.6. So after that, what am I going to do? I'm going to add this cash. This depreciation tax shield, I'm going to add it to the earnings after tax to get what we call the net cash flows, annual net cash flows. This will give us the annual net cash flows. Annual net cash flows is equal to EBDT times 1 minus T plus DTS. So let us add. I have 17.6 on my machine, so I just add the 350 to get 367.6. Then I add 350 to 26.4, 376. This is cannot be the same. This is 350 plus 26.4 plus 26.4, 370. I'm getting here 376.4. 376.4. 376.4. Then I add 350 to 28.8. 350 plus 28.8 is equal to 378. 378.8. 378.8. These are annual net cash flows. Annual net cash flows, meaning these are annuities. These are the expected cash inflows at the end of every year. And why are we calculating these annual net cash flows? So that we can calculate the NPVs for each alternative. NPV for each alternative. So that is important working there. So I'll come here and have other workings. I can have more workings. Okay. So candidates, you are going to begin with the calculation of the NPV of the alternative where the computers are expected to last for 5 years. 5 years. And I've just said these annual net cash flows are annuities. Annuities, annual net cash flows. These are cash flows. Here we have cash flows, cash inflows minus cash outflows. The cash outflows we had calculated will be 880,000 for the 3 alternatives. But for the cash inflows, they will vary, and you can see we have the annual net cash flows which are different. Another point to note before we calculate the NPVs is that we need to check if there are any other cash inflows. And these cash inflows, as usual, will always comprise, in most cases, the terminal cash flows. Terminal cash flows comprise the salvage value. If any machine will be disposed of at the end of the economic life, then that is a cash inflow. That also would include the net working capital to be recouped. In this question, we do not have the working capital elements, but we have the salvage value for the first alternative. Salvage value, remember here, was 50,000 shillings was to be raised at the end of the 5th year per computer. And that, if I can read from note number about the marketing manager down there. On the other hand, the marketing manager argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. That means that the total salvage value, which will be equal to the total cash flows, terminal cash flows, will be equal to 50,000 shillings times 8 computers, which will be equal to 400,000, which we calculated here. So for the first alternative, the NPV for the first alternative, where the economic life is 5 years, the present value cash inflows will comprise this annuity of 378,800 plus the salvage value. So the NPV will be equal to the NPV for the first alternative. This 5 should tell you that is the first alternative. That is equal to the annuity, this annuity, 378.8 times the present value annuity factor. The discounting rate we saw from the question is 24% at 5 years. This is the present value of the annuity, and we will read this from the tables. Then we will add the present value interest factor at 24%, 5 years, times the salvage value of 400,000. Then this sum, this will comprise the present value of the cash inflows. Then we deduct the cash outflow, which is 880,000. This is the initial. That will be the initial cash outlay. So we can insert the inputs. We have the annuity here, that is 378.8. 378.8 times the factor, which can be read from the tables. From the table, the annuity, present value of an annuity, 24%, 5 years, 24%, 5 years, 24%, 5 years. The factor is 2.7, 454 plus the present value 24%, present value interest factor 24%, 5 years. So I have 3411, 0.3411 times 400,000. All right, this we are going to subtract 880,000. So I look for my machine and get the answer. So here I'll have 378.8 times 2.7454 plus 0.3411 times 400 minus 880. So the NPV here is equal to 29. Let me put the units. These are shillings. These are shillings, 29 shillings, 296,398 shillings. That is NPV for the first option. The second option, NPV, where the economic life is 10 years, will be equal to the annuity times present value annuity factor 24%. How many years? These are 10 years. 10 years minus 880,000. The annuity is 376.4. 376.4 times the annuity rate from the table. This is an annuity, 10 years, 24. 10 years, 24, this is 3.6819. 6819 minus 880. So let me do the calculation. 376.4 times 3.6819 minus 880. This is equal to 505,867. Next is the NPV. NPV for the economic life of 15 years, you have the annuity times PVAF 24%, 15 years. 15 years. 15 years minus 880,000. This is equal to the annuity 367.6 times the annuity 24%, 15 years. 24%, 15 years. This is 4.00 13 minus 880. 880. What is the NPV? The NPV will 367.6 times 4.0013 minus 880. Minus 880. This is equal to shillings 590,878. So these are NPVs. The NPVs for each alternative. Alternative 1 is where the economic life is 5 years. Alternative 2, the economic life is 10 years. Alternative 3 is 15 years. And why are we calculating these NPVs? Is so that we can answer the question which required us to calculate the expected NPV. The question is, let me read it. The question is, let me go back to the question. Expected net present value of the project. Expected net present value of the project. How do you calculate that? We had the formula. NPV of the first alternative, which we have, so we can insert the inputs. We have 296,398 times the probability. From the question, we have the probability of 0.2. Was it 0.2? Yes, 0.2. 0.2 plus, this plus probability is 0.3, the NPV second alternative 505,867 times 0.5, is it? Yes, 0.5 plus the probability where the economic life of the machines will be 15 years. The NPV is 590,878 times probability of 0.3. So this will be the sum of the three will give us the expected NPV. 296, 398, 398 times 0.2 plus 5 of 5, 867 times 0.5 plus 590, 878 times 0.3. So the expected NPV is shillings 489,000 477. That is the answer, and that would earn you how many marks? 4 marks. 4 marks. All right, those are workings, which would help you earn how many marks? 4. All those workings are to help you earn how many marks? 4 marks. So that is part 1. Required Roman 2, the standard deviation of the expected NPV, the standard deviation of the expected NPV. 2, this is the standard deviation. Let me write it properly. Number 2 is the standard deviation of the expected NPV. I'll summarize it as standard deviation of expected NPV. Standard deviation of expected NPV. Now, the formula for the standard deviation of expected NPV will be equal to the square root of the summation of the values. N is equal to 1, NPV, these are deviations. Okay, we get the deviations, NPV minus expected NPV. We will square the deviations, then multiply by the probabilities. So we are simply going to get the deviations, because we have the NPVs for each alternative. These are the NPVs for each alternative, and we have the expected NPV. We have it. We get the deviations, square the deviations, and then multiply by the probabilities. So candidates, I'll start with have a column for probabilities. We have the probabilities. This is 0.2 for the first option, 0.2, the third option, 0.5, the second option, the third option, 0.3. Then I'll have another column for NPV. You have NPVs for each option. We subtract with the expected NPV, which you have calculated here. Expected NPV, we will then square the deviation. This will give you the deviation. Okay, the deviation from the expected NPV. then we will multiply with the PI. We'll multiply with the PI, then we'll get the summation. Going to do the summation here. So let me be economical. Let me be what? Economical. We are calculating the standard deviation. So let's start with the first option where the NPV is 296, 398 minus the expected of 489,477. So I have the deviation, which is a negative. Then I square it, then multiply by probability 0.2 times 0.2. So I'm getting here 7,455 900 048. The second option, 505 is NPV 867 minus expected 48,977. That is the deviation. I square the deviation, then multiply by 0.5. The answer here is 134,316. 134,316, 050. Then lastly, the NPV for the last option, 590. 878 minus expected NPV 489,477. I'll square the deviation, then multiply by probability of 0.3 to get 3,084, 64, 8, 840. Then I'll get the summation. I'll add these three. So when I add, this is equal to, that is 745590048 plus 134316050 plus 308,464,8840. So I have the total there. Then let me do the standard deviation. The square root. The square root of this total is the square root of this total. Let me just do the square root of this total is equal to. So the answer, candidates, the square root is the standard deviation is 103,319 .238. That is the standard deviation of the expected net present value, and that we've answered part 2. Now Part 3 says, let's answer part 3. It says if the net present value of the project is less than 200,000 shillings, the firm will be exposed to a financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution. 3 marks. Determine the probability. Let me rub here. Determine the probability that the firm will avoid financial distress. Probability that the firm will avoid financial distress. And if the net present value of the is less than 200,000, the firm will be exposed to a financial distress. If the net present value of the project is less than 200,000 shillings. 200,000 shillings. Determine the probability that the firm will avoid financial distress. This is part 3. Part 3, probability that the firm will do what? The firm will avoid financial distress. So learners, for us to calculate the probability, first we are going to calculate the Z score or the Z value, and we know that the Z value or the Z score is equal to X, which represents the actual value. In our case, that will be the 200,000 shillings minus the mean mu divided by standard deviation. In our case, this is the general formula for calculating the Z score. In our case, the X will be the NPV of 200. That is at the point where the firm is likely to avoid distress. We've read that if the net present value of the project is less than 200,000 shillings, that will be the value for X or the NPV. Then the mean is the expected, that will represent the expected NPV. Expected NPV, that is expected NPV divided by the standard deviation of the expected NPV, the standard deviation of the expected NPV, which we have calculated here. We have the mean or the expected NPV, and we have the 200,000 shillings minus the mean of 48,947 divided by the standard deviation 103,319. This will be the Z score. So let me take my machine, and I can see there that is a negative. That is negative. It's a negative of 200,000 minus 48,947 divide 100. This is 103,319. This is equal to 2.8017. If I was to round it to 2 decimal places, this would be equal to 2.80. This is to 2 decimal places. So this Z value, we will now, candidates, read from the standard normal curve, the 2.80 as read from the normal curve, The value here is 0.4974. Now, candidates, if you are to draw the curve, let me just draw the curve to explain how we will arrive at the probability that the firm will avoid financial distress. If you are to do a normal curve, this is what we will have. This is what we are going to have. Our mean value, NPV. NPV here is at this point, and the amount, the value there is 489,474. We all know this region represents probability of 0.5%. This is only 0.5%. 5%. So what is the probability that the firm will avoid financial risk? Okay, if the financial distress, this is financial distress. If financial distress, we learn from the question, we read from the question that if the net present value of the project is less than 200,000 shillings, if the NPV is 489, that is the expected NPV, this is the mean, we say this is the mean. If the mean NPV is at this point, and we read that what is the probability that the firm will avoid financial distress if the NPV is 200? Because if the mean NPV is 489, then the 200 will be this side, on the left-hand side, because we're counting, assuming this is a number line, this will be 200,000 will be at that point. 200,000 will be at this point. We know that this is a probability of 0.5. So we need to calculate the probability that the firm will not get into financial distress, and that has to be this region, okay? This region, because this region if the region below 200,000, this is a region of financial